All of that for you at 8:30, and Michael McKee leading our coverage here into tomorrow's jobs report. We will go beneath the headline data. Always beneath the headline data is Damian Sassower, Chief Emerging Market Credit Strategist for Bloomberg Intelligence, and he knows that when the acts of UBS, former now at Oxford, I should say, George Magnus writes, you read it and listen. George Magnus with a tour de force in The Guardian a couple days ago, alluding to the instabilities of China back to Japan of 1994. Have they screwed it up so bad they're like Japan of 1994?
Well, let me put it back to you. Why are we even talking about China here? It's certainly not from an investment perspective. Everyone I talk to, considers China to be broadly uninvestable. I'm talking about foreign investors.
Straw hats and winter, you buy it right now?
Well, I think you talk about it because it's the world's second largest economy, and what's the pass through to the U.S. and Europe and to demand writ large. And from that perspective, it's dire. The conditions domestically are dire and getting worse. If you look at PMI data or average salaries, which have declined 1.3%, the biggest year-over-year decline since 2016. There's plenty of data to point to. But I'd much rather talk about U.S. Treasury yields, because the pass through from U.S. yields into emerging markets, which is where I live and breathe, is going to have a much greater impact on valuations and performance the full year.
Well, let's talk about both. When you look at EM as an asset class, has the aversion towards China shaped the approach elsewhere?
Yeah. Absolutely. Look, I think in this market, what you're looking at more or less is LATAM and EMEA. You really can't look at Asia because it's a low-yielding environment. And the fact is, central banks didn't have to hike as aggressively because inflation is kind of structurally low there. That doesn't mean that there aren't opportunities there. But if you look at places like Indonesia, they're still raising rates in what is effectively an easing cycle synchronized across the rest of the globe. So from an EM perspective, nominal and real yields are still very high in Latin America, still very high in EMEA. And from a valuation perspective, for those of you that believe that carry's kind of had its day in the sun, 4 years of outperformance, and we're going to kind of have this regime shift toward value as being the driver of EM currency performance, well, then you probably do want to look to the EMEA region, and from that perspective, Hungary, Czech, and a lot of those names come out.
I'm not going to let you discard the China discussion so quickly, because I know it's complicated, and I know that nobody's been able to get it right, but recently we're seeing yields go down pretty significantly on Chinese bonds, and this is because there is this promise of more stimulus. There seems to be heightened concern on the part of the PBOC, Xi Jinping, about the economic considerations in the nation. How much can you lean into that, given the fact that some people are starting to say, look, it's so uninvestable that it looks like a good deal?
Lisa, it's right to focus on that, because the stimulus that China kind of injects into that economy is going to filter through into the broader world at large. But I think what you're saying is actually spot on. The data points you want to look at, 3% budget deficit, that's what they're targeting, 3% of GDP. That target was set last March. They never reached it because of the broad fiscal stimulus. It actually, I think, declined in China in large part because of what you're pointing out, lower China yields, weaker yuan. So every yuan of stimulus they're injecting into the economy in dollar terms is worth that much less. And so from my perspective, stimulus does matter in China, but it's got to be the right stimulus. It's got to be the execution of delivering that stimulus, and that's where things get a little bit dicey in my mind.
I think it's interesting that you also didn't want to focus on China because so many people say it's uninvestable. There was a report that came out that was highlighted on the terminal talking about how Citigroup, JP Morgan, Bank of America, and Morgan Stanley collectively have reduced their exposure to China by about a fourth since 2020. This has been a dramatic retracement out of that country, the world's second biggest economy. Does this make it difficult for people to even play in the spaces they've wanted to? In other words, is this basically an uninvestable area just because a lot of financial firms don't want to engage given the unpredictability of policy?
So clarify for me, are you talking about their investments or their companies, like banking branches in China? Because I think it's important to differentiate between that. And when I say is, we're reading and we're hearing about data transfer rules, cross-border data transfer in China is becoming increasingly difficult. The cost burden of doing business in China from the perspective of JP Morgan, Goldman, Morgan Stanley, et cetera, has become so hard because they have to ring-fence their local operations from the broader bank because of this data transfer and all the stuff that goes on, compliance-driven, et cetera. And so, it is a very difficult endeavor to invest in China from the perspective of the C-suite, right? And I think that is kind of filtering its way down into investment portfolios, et cetera.
Okay, I want to go to something actually in the Damian world. You mentioned LATAM as being interesting.
Yes.
The Bonos de Tesoro area of Peru. Okay, I'm buying it with a 6 and 7/8 yield right now.
Yeah.
It's down 32% from the beginning of the pandemic. It's come back a little bit as well. How do mere mortals on TV buy the
10 years
bonus
sobreras,
to
yeah.
area of 2034?
Yeah, no, I mean, your guess is as good as mine. You're going to have to call your broker at JP Morgan to get a proper quote. No, I'm kidding. I mean, you can do it.
I mean,
You
the
wouldn't do it
strategists
because the
at
denomination.
big banks, do they actually follow this stuff, or is this just the way?
How many U.S. Treasuries do you own outright in your portfolio? I'm not your bad example, but most people don't own U.S. Treasury notes in their portfolio. They own an ETF, or some they get exposure, kind of that way. In Peru, if you're looking at Peru 10 years, which we like in a hard landing scenario because it's a dollarized economy and yields are high on a nominal basis, the only way to really get that exposure is via an
what's
ETF.
What's the top Bramo can get in her 401k from the bonus to tesori area
What's that
of
yield?
2034?
Why do you like saying that
I
so
don't know,
much?
just enjoys butchering it. I've got no idea.
Like, what is this?
I mean, look, there are a lot of fun-sounding instruments. We could talk about TIA swaps in Mexico. I mean, they're wonderful.
But are you talking 20% pop in your
We could talk about Ray I and DI futures in Brazil. No, I'm kidding. But I think, look, Brazil, Mexico, Peru as well, the yields are really high on both a nominal and a real basis, and they're attracting a lot of investors to their shores, and it's showing up in spot FX performance. Spot EMFX performance, forget about total returns, which includes all the interest return, was actually positive in 2023 for the first time in, 5-6 years? Amazing.
Let's finish on this. I think sometimes on programs like these, we say things that are actually really, really important, gloss over them and move on. We're talking about the world's second largest economy, and the markets of the world's second largest economy being uninvestable.
Yeah.
And we're sitting around this table as if that's just something everyone knows already.
Right.
Does that matter to leadership in China, that you have got a whole universe of investors that are looking at an economy that is so important to the world, and yet we believe, and I say we, I'm talking about a group of investors, they believe that economy and those markets are uninvestable?
I mean, I'm certain that Beijing does not like the sound of that, but I don't think they're listening so much to what you or I or Tom or Lisa are really saying, Jonathan, or for that matter, Jamie Dimon and a lot of other people. Yeah, they take it with, some meaning, of course, but I don't think, there's much they can do about it, A, at this point, but B, it would take a regime shift or something really, to dial back a lot of the constraints that, President Xi and Beijing put on the broader economy. To dial a lot of that back at this point would be almost an admission of failure. It wouldn't happen, I don't think. And so, look, I profess to be somebody who knows a lot about China and how to incorporate our China views into a broader portfolio, but I am not a China expert, and I do not know what's going on inside the walls of Beijing, and I need to make that clear. But yeah, I mean, from the people who I speak to, I trust, implicitly, they do not have China in their portfolios at all.
Just an amazing shift over the last few years. Damien, thank you. Good to see you. Happy New Year. Damien Sassa of Bloomberg Intelligence. TK, we say it so casually. China, uninvestable. It's just become the consensus view on the street in the last few years.
Totally agree with you. It's a seismic change, and I'm reading as much as I can on it, and it stops, as you say, John, with the government, with a totalitarian regime, and what's the next step?
And that's the reason why I was interested in the Central Commission for Discipline Inspection, which I do like saying, but this is the China group that told bankers last year to abandon the pretense of the financial elite by cleaning up their, quote, hedonistic lifestyles. Basically, this is what caused the lack of flying first class, et cetera. How coherent is a thriving banking system with a country that is professed to be communist? Does that mesh up? And if you start to have the sort of ideologies of communism being more directly imposed in the country, how do you get any confidence that they're going to really invest with some sort of capitalistic sort of overlay?
Tell us, Tom, is the first class cabin a little quieter? What's it like over there?
Yeah, it is. It's quieter. Yes, no question about it. John, I don't have the Peru piece, but my Austrian piece, I mean, it was only down 74% at the bottom.
Has it bounced?
Yeah,
nice.
It's bounced. It's got a little Austrian, Velda bounce.
I can tell you equity futures totally unchanged on the S&P. Coming up, Katie Kaminsky of Alpha Simplex on whether she's short treasuries.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. From the world of politics,
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more
excited at what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time, join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
Crisis is too strong a word, and words like that get used a lot.
from business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Are you in recession or are you not in recession? And we have a very low probability of recession this year.
We are not out of the woods when it comes to battling inflation.
The pain trade is that everybody thinks that inflation is fully vanquished.
Either inflation falls because the economy continues to weaken, or the economy stays strong.
What we need to focus on is what's happening with the data, and what we need to understand from the Fed is it only inflation, or are they taking into account a slightly softer economy?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
New Year hangover continues. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P today, this morning, totally unchanged. After yesterday, 3-day losing streak on the S&P, 4-day losing streak on the NASDAQ 100. TK, a real struggle, a stumble out of the gate for the new year.
A little better to tape after the 2 days of carnage that we've seen. We've got a wonderful person coming up, John, who was wrong last year. And John, you see that within the jobs report moving from early December over to now, where you go from 4.23% to 3.96%. Guess what? The world has changed at the beginning of 2024.
Next stop is the economic data. Later this morning, we'll get jobless claims, Lisa, the ADP report, setting up the big one tomorrow morning. Payroll's just around the corner.
How high is the bar for it to really shift the needle on the narrative? This is really my question at a time where we're seeing incremental shifts and incremental weakening to the labor market, but not anything that necessarily screams some sort of cataclysmic fissure in the labor market. You're laughing, but it's seriously, how does the market deal with vague and sort of incremental moves? Not well, and that's what we're seeing.
We've got a gap right now that we need to talk about. How'd you close this spread? The implied forecast, if you want to call it that, the median dot in the dot plot from the Federal Reserve for where the dots will be at the end of the year. You know where I'm going with this. And where the market is priced for rate cuts through the year so far. How does that close? We got some pushback, I think, in the minutes yesterday. Citi's Andrew Holness called it a fine-tuning event fine-tuning a very dovish meeting. Alan Zettler and Morgan Stanley said rate cuts aren't coming soon. I mentioned this quite a few times already, Lisa, worth repeating. Jeffrey saying attempting to put the toothpaste back into the tube.
So this is what fine-tuning looks like. Before some of these minutes came out and some of the rhetoric came out, we saw almost an 86% chance of a Fed rate cut in March. Now that's all the way back down to 65% chance. So it's still necessarily getting priced into the market, but not maybe with as much conviction.
And to me, what's so important here is they are wedded to a Greenspanian measured. I mean, every single conversation, whatever anyone's belief, we're going to be measured and move incrementally a quarter point at a time, where a lot of people are begging for Arthur Burns, where they say, okay, things have changed, we're going to move once, but we're not measured, we're just moving to move. I don't hear that out there.
So this is the economic data and how the Fed might respond to it. Let's talk about the earnings as well. 2 Fridays away, JP Morgan results just around the corner. We'll be talking about the big banks first. Then early February, we need to talk about Apple. Apple, the standout name, as you might expect, already to start the year. We had a downgrade from Barclays, got another one this morning. Lisa, this time from Piper Sandler's Harsh Kumar, downgrading the stock to neutral from overweight, talking about valuation concerns and broader handset and macro weakness for the first half of this year.
The thing that we keep talking about is we all know this. This was not a new story. We were talking about this last year. They did not see sales growth, and yet their shares still rose about 50%. We're seeing that come off. How much further does it have to go after the longest streak of losses in the NASDAQ 100 going back a couple
Is
months?
Mr. Master, he's got buy orders in this morning at Cupertino? I mean, I believe I saw modeled yesterday. They're going to spend $80 billion or $50 billion. The number doesn't matter. The answer is a lot of money on share buybacks. If you love this puppy at 200, you got to really love it at 182, right?
Well, all I can say is, if you take that logic and you brought it out to the big tech sphere, did you see Mark Zuckerberg of Meta sold the greatest amount of his own personal shares going back to 2021
yeah, but he's buying,
on the heels of everything? My point is, how much can you glean from whether they're buying or they're selling, right? If they are going to not do buybacks, does that mean that they don't have faith if they can necessarily generate the growth in the ongoing at Apple?
It's a monster cash machine, TK, which is the point you're making at Apple. It will continue to be a monster cash machine through the year, over the next year. Tom, the problem was for last year is that what you saw was an expansion in multiples at the same time that their core product wasn't seeing any sales growth. That was the tension. Now, look, the bulls were right on the stock. Whether they were right for the right reasons, I don't know. We can talk to the bulls on Apple about that. But ultimately, that's the challenge, Tom, coming into 2024.
Yeah,
can you really repeat that act in 24 after what you saw in 23?
Yeah, the nuance there is foreign exchange adjustment and also the premium phone sales, the unit sales as well. But the short answer here, not to beat it to death, is there's a raging debate, like on the 10-year yield, as there is on Apple Computer.
Stock is down 0.7%. We'll talk about the bond market in just a moment. Here's the broader price action. Equity futures on the S&P, 3-day losing streak on the S&P through the close yesterday. This morning, just moments ago, Lisa, turning negative on the S&P 500.
All right, in 55 minutes, we're going to get German December CPI. Very curious to see European inflation reads and how that really features into the Fed ECB divide that we keep hearing about and the bond market more broadly. Meanwhile, 8:15 a.m., we get the ADP December employment change. Tom follows that very carefully and trades aggressively off at 8:30 a.m. We also get initial jobless claims, which may be more important. Yesterday's JOLTS data showed a softening in the market that was material when you look at measures like the U.S. quits rate, which ticked to the lowest going back to September 2020. When people aren't quitting, they don't have confidence that they can get another job. That's sort of the idea behind why this is important. And at 9:45 a.m., we get S&P Global U.S. Services PMI, focused very much on services since that has been the stalwart of expansion, even as we see manufacturing contract.
Should we talk about the journey of an investor, a painful one? It felt good for a long, long time. You short treasuries. You start the year at 390 on a 10-year. It gets to late October 23rd to be precise, and a 10-year yield goes to 5.02%. You're feeling good about that short. You stay short. Then all of a sudden, the 10-year goes back to where it started, 390 to end the year, just where it started the year in 2023. Joining us now, someone who was short through most of that year, Katie Kaminsky, Chief Research Strategist of Alpha Simplex, punishing that bond market, Katie. You were short, we talked about it, it felt good for a while, then this market turned. Katie, I guess you're still short after the pain of the last couple of months, and what changed for you?
No, trend signals have finally turned long, and I think this is an epic signal for the market because we have been short for 9 quarters. This has been one of the longest shorts in trend following history over the last 20 to 40 years. And I think this is important because it signals the end of the tightening cycle, and it suggests that we're going through a regime change and that we need to start looking at the next phase of the bond market. And for me, that's looking for a steeper yield curve. And I'm trying to think about what is going to be the catalyst for that as the next phase of this trade.
It's one thing not to be short, Katie. It's another thing to be aggressively long. Where does trend following signals send you?
So right now, they're still rather muted, but I think the key that we're going to have to watch is how fast are cuts coming. And I also think we have to be a little bit nervous, too. We need to watch what's happening with supply and treasuries to look at the end of the curve to see what's happening there as well as we try to navigate this year as weaker data might come in and as we try to roll over debt throughout the year. So I think this is going to be a year to watch the shape of the curve and to see where the curve actually settles out.
When you talk about a steepening in the yield curve, it can come from two places. It can come from short-term yields coming down in response to Fed rate cuts, or it could come from longer-term yields rising aggressively. Are you basically saying because you are no longer short treasuries, that you see it more coming from the front end with more aggressive rate cutting cycle than people are expecting?
Well, that's the trade that everyone's focused on. And I think that's where everyone's focused right now. You were just mentioning it, that, we're focused on how soon are cuts coming and when are we going to see the shorter end of the curve sort of deepen so that we have this more steep yield curve. I think where you have to worry, the typical thing that would be the challenge is if we start to see more challenging effects on the long end of the curve, aka poor fixed income market on the long end. So that would happen if we had trouble in terms of valuations for debt, and so that would happen if we had poor auctions in the treasury market. So that's something I'm going to be watching this year.
Katie, let's talk to Global Wall Street right now that hangs on your every word on trend-based CTA technical analysis. So we had a trend to a higher yield in the 10-year. We've rolled over. The indeterminate point I call soup. Are we in a trend of soup now, indeterminate, or can you state that we have a trend towards lower yield? Is a trend in place of higher prices and lower yield?
So we hit the inflection point and we've started moving towards longer signals, especially in most asset classes, particularly equities. We've also seen very strong short signals in the US dollar. So we've really seen that inflation trade that we were seeing for pretty much 2 years dissipate and move past a point where we're moving towards a new trend.
You sound like Louise Yamada there talking about dissipation. What will it take to get trend in place where there's a permanence to weak dollar, a permanence to lower yield?
I think rate cuts, as expected, would definitely continue that trend strongly. Of course, not as weak data if we continue to see this sort of soft landing be a possibility. And I think that is going to be in question, of course, because my general view this year is that we're going to see a lot of variation in outcomes. I want to point out one key fact. Bond volatility still remains elevated, and bond stock correlation still remains positive. Those are two technical factors that are very different than the classic regime. So we need to navigate those first before we can figure out sort of, have we moved to sort of back to where we were, or are we moving somewhere else?
Hey, Katie, let's finish there. We caught up with someone just yesterday from JP Morgan. Lisa mentioned them, Phil Camporelli. He talked about 60-40 being back and that 40 would enable you to play defense. Is there any reason to believe that it is back? Are you seeing anything that suggests that correlation is going back to what some people might call slightly more intuitive?
I think everyone wants that, but I think the worry is what I just said. We're seeing very different asset class relationships, so we need to watch inflation and watch for how inflation behaves, because inflation changes the nature of asset class relationships. If we should see inflation have upside risk potential, we will see more challenge to that 60-40 narrative. If, in fact, we can keep inflation under control, I agree. The 60-40 is a good place to be. But so watching inflation and keeping that in check, and that's why the Fed is probably being more conservative and being careful because they want to make sure that's the case.
Katie, appreciate the update. Happy New Year. It's going to catch up. Katie Kaminsky of Alpha Simplex no longer short this bond market after a rip-roaring rally through November and December. Lisa, please, you brought that up. It's so important. This 60-40 call, the return of the 40 being a defensive story, that we retain those risk mitigation characteristics when they have been the source of risk for much of the last 12 months.
And what Katie was saying was really important, that it only goes back to being a 60-40 kind of ballast if inflation comes down materially, because then suddenly we're not talking about inflation as the main risk, which it has been for so much of the past 24 months.
If you are just joining us, welcome to the program. Here's the equity market for you. A bit of a struggle to start 2024. The last 2 days have been a couple of days of losses. You put it all together, 3 days of losses through the end of 23 into 24 on the S&P 500, 4 days of losses on the Nasdaq 100. Equity futures here on the S&P up by just 0.04%. Yields higher by, let's call it 4 basis points, 395.92. With economic data, Lisa, about an hour away.
Yeah, what we forget first is the ADP report, which does come out, doesn't necessarily have a direct correlation to tomorrow's non-farm payrolls report, but still, again, all of these indicators get more important when all of a sudden it's incremental. I keep focusing on that because I gotta say, it is hard for a market that's used to whipsawing to respond to incremental moves. Do you get an oversized move in markets that are kind of on pins and needles trying to come up with a new discussion point?
But the new discussion point is the new narrative, and I think it's huge indecision on what the new narrative is. There's people making bets. That's their job. Strategists' jobs is to make the bet. But today and tomorrow, and I believe it's January 11th, it's CPI, I'm guessing. The answer is we're going to have a lot of narrative here out to get to January 11th before JP Morgan's earnings.
I can confirm on my screen it is the 11th.
Nailed
the
that.
CPI.
I don't know how to do that.
And then after that is JP Morgan earnings. So that's the calendar is packed. You've got all the earnings. Starts next week for the big banks. Got all the data. Tom mentioned the 11th for CPI, this Friday for payrolls. And then we've got these spending deadlines for the government down in Washington, D.C., and we need to talk about that too. One deadline is the 19th of this month. The other deadline, early February. Coming up very shortly, Greg Valliere of AGF Investments to weigh in on all of that. And in the next hour, Drew Mattis of MetLife is going to join us to go through some of these bond market moves. Equities this morning just about positive on the S&P 500 from a beautiful New York City. Good morning.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was
The
expecting.
bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
base case is drama, brinkmanship. It does seem like we could easily get that government shutdown. But from a market perspective, yeah, I tell clients to kind of pay attention to that longer term provision. I do think we will get government funded. We will get a defense supplemental. We will get something on the border. It's just a question of timing.
The two deadlines over the next 4 weeks in Washington, D.C. That was Ed Mills, the Washington policy analyst over at Raymond James. Here in New York City, good morning to you. Equities just about unchanged on the S&P 500 after a few days of losses on both the S&P and the Nasdaq to kick off 2024. Unchanged now on the S&P, and the bond market yields higher by, let's call it 4 basis points on a 10-year, 396.11 on a 10-year. In foreign exchange, the euro just a little stronger here by 0.25% against the dollar, 109.50. If you want to sit on crude just for a moment, picking up yesterday, biggest one-day rally going back to November, middle of November, I think, TK. Picking up again today by 1%, $73 and about 40 cents.
You have to watch it, the spread there between America's price of oil as a dominant provider and Brent crude as well, which maybe has more to do with the Eastern Mediterranean. $78.83 on Brent crude. And, you know, it went down and it's sort of trying to come back against this horrific backdrop of news.
And it's escalating, right? I mean, that seems to be the clear discussion from overnight. There was an article in the New York Times where Admiral James Stavridis said this: the chances of a regional war in the Middle East go up from 15% to as high as 30% in light of the recent attacks in Iran and given some of the discussion.
Does the war spread, Tom? The prospect of escalation is the number one question over the last 3 months. Crude has traded lower through October, through November, through December. We're still asking the same question.
We're going to digress right now, and joining us is someone with huge experience on America's attitude towards the Eastern Mediterranean and something talked less about, which is Lebanon. This is, of course, northern Israel and the Hezbollah and all the news flow we've seen there. Greg Valliere joins, Chief U.S. Policy Strategist at AGF Investments. I mentioned, Greg, a small matter of the U.S. Marine Corps in Beirut 40 years ago. I got a huge response on social on that. What is the American relationship with a fractured Lebanon? Essentially, no government, Hezbollah active there as well. What is our policy there now?
Well, I don't think we want to get into a full-fledged conflict, Tom, but you look at the assassination earlier this week of the Hamas leader. You look at what happened yesterday in Iran, 100 people killed, and the Iranian leadership is blaming the U.S. and Israel. I don't think the U.S. or Israel had anything to do with that bombing. I think it had to do with other factors within Iran. But this is a tinderbox with the Red Sea and the Persian Gulf being crucial for oil. And I suspect things may get more tense before they get better.
What do we need to see from our State Department? How do we extend to a greater conflict in the Eastern Mediterranean?
I think we have to make it clear that we're prepared to get involved. I think we can't just sit by and see shipping lanes in the Red Sea or the Persian Gulf stay undefended. So this will call for tough rhetoric at the very least.
Tough rhetoric at a time where the U.S. is still struggling to figure out how they're going to pay for some of the funding behind the rhetoric. How much does this discussion play into some of the deadlines that we've been talking about? January 19th with one funding deadline, early February with another.
Yeah, you know, Lisa, everyone's been very sanguine that, oh, we'll get a deal by January 19th. We'll get something on February 2nd. There's a new player in town who is not that inclined to compromise, and that's Mike Johnson, the new Speaker of the House. He made it clear yesterday that this is not just radical Republicans saying we don't want to spend more money. It's all of the Republicans, and their big mantra is the border. And unless there's a serious border bill, and I don't think there's anything close to a deal yet, I think things could grind to a halt in the next few weeks without a deal.
People have gotten so immune to the idea of just complete stasis in Washington, D.C., on the brink of dysfunction or outright dysfunction. At what point, Greg, does it start to matter for a longer-term kind of perspective that there are these government shutdowns that are constantly being floated and that there is this sort of hardline approach being taken where it seems like there's not going to be a deal anytime soon?
If there's nothing, or if there's a delay, and you certainly can't rule that out, what kind of a signal does that send to our allies? What does it send to Ukraine, which desperately needs more funding? What does it say to the Israelis, to Taiwan, to others? I think that's one big concern. The other is just consumer confidence. Consumers in the U.S. may begin to see, as you say, the stasis without anything getting done.
Greg, Gallup did a great treatment in the summer of last year on how we feel about immigration. You followed this through cycle after cycle. You read the history of it across decades and decades. We moved from 77% immigration is good, and we're down into the 60s, and it's been a little rocky. Do we believe immigration is good on Capitol Hill?
Too much immigration is not good, Tom. And last year, we let 2 million people in at the U.S.-Texas border. That is not sustainable. And if you don't believe me, talk to all the Democrats who are mayors around America. They're desperate. They don't know how to fund aid to these people, and there's still more coming in.
So, Greg, let's talk about who's running the party. You mentioned Speaker Johnson. Is it Speaker Johnson or whoever's leading the polls in the primaries? Who is it?
Well, I think they're just fighting for second place, John. I don't see maybe a chance in New Hampshire that Trump could slip below 50%. Trump will do very well in Iowa. I did a piece earlier this week saying that we could see Trump as the presumptive nominee by Super Tuesday, which is March 5th. Wow. It's entirely possible this will be over in 2 months.
So, Greg, let's go to the spending bill, the border agreement. What does an agreement look like that makes Republicans happy? How big is that bill? What does it look like?
A de facto wall, I think something that militant, a lot more money for agents, sending people back. A lot will have to be in this bill. And the Republicans in recent weeks have become emboldened to ask for more.
Particularly given the headlines we've seen, Tom. I saw a number like 300,000 for the month of December.
There's
being
been a
processed.
shift.
Record month.
Bloomberg News with Matt Winkler's leadership has been great about following this immigration debate. This goes on years and years. Greg knows this as well. But you're right. In the last number of weeks, it's reached a new point. There's no, whatever anybody's belief on it, we're at a new, not frenzy, but new study of what are we going to do.
Hey, Greg, thank you. Good to catch up. Greg Valliere there of AGF Investments. Greg, Happy New Year. It's TK the change, and Greg mentioned it. The crisis was on the border, and what's taken place in the last 12 months. The crisis is now on the doorstep of blue states that could look from above and look down and say this is not a problem. And now it's everyone's problem.
I'll give you one anecdote. I gave a speech in Arizona, and I'm driving down the road, as usual, John, in the back seat of the fancy car, and I said some East Coast bow tie BS, and the limo driver took my head off. And he said, "You're in the Northeast, you don't know the issues." This had to have been 200 miles from the border, I'd say.
To the point that we're seeing, even in blue states, you're starting to see busloads of immigrants come in, and it's really posing a strain on the social system. There's a real question here why there isn't more urgency on both sides, right? I mean, you've got this sort of Republican pressure, but on the flip side, where is President Biden on this? He has sort of nodded to this idea that there is some issue that needs to be resolved. Why are we not hearing about the nitty-gritty in a more concrete way? Because there is responsible immigration, and this is a nation of immigrants, and that's a great thing, but it has to be controlled.
The nitty-gritty to me is the Hispanic vote, the black vote as well, maybe the other groups as well that I don't have in front of me. But the answer is this is hugely dynamic, and it's something all of these politicians are following. The things we took for granted 4 years ago, 8 years ago, 12 years ago, John, out the window, absolutely out the window.
Totally. Something we'll continue to follow in this election year. Coming up on the program, Woody Caesar of Credit Sites, their conversation just around the corner. Price action shaping up as follows on the S&P 500, just about unchanged. The story of the next hour or so, 8:15 Eastern Time, the ADP report, the appetizer for the payrolls report tomorrow morning. Then at 8:30 Eastern Time, a little bit later this morning, jobless claims in America. The estimate, 216K. From New York City, this is Bloomberg.
sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Let's go straight to the scores in the market right now on the S&P 500, trying to bounce and struggling up by 0.1%. Negative again on the NASDAQ 100. NASDAQ 100, four-day losing streak. Four-day losing streak. Incidentally, the last time we had a day of gains on the NASDAQ was late December on the 27th, I believe, which was the low on the 10-year for 4Q, which was 378. And since then, yields have been climbing just consistently. It's been a slow grind, but look at where we are now, from 378, which was the session low on December 27th, to where we are now on a 10-year. If you switch up the board, 2-year, 10-year, 30-year looks like this. The 10-year at the moment, Lisa, at 395. So we have drifted higher over the last week or so.
With people pushing back on this idea that the Fed is going to cut for, 6 times this year, and I think that that's been sort of the theme of the beginning of this year, but it's been incremental, and that's what the minutes have also shown, incremental, and that's why it's been very difficult to hinge on a new narrative, because traders that have been used to overdramatic swings are not good at incremental.
Yields drifting higher, Tom, incrementally again this morning by a single basis point. The 2-year, 435.
Off the news, let's remind ourselves we're here in 1 hour on the key beginning of the news. I mean, ADP, yeah, okay, but, the claims, I'm sorry, it's real. And then tomorrow, a real story here with the jobs report, and that's going to be part of the narrative onto inflation, January 11.
The estimate, 171. Let's get to foreign exchange, then I want a single name. We'll talk about Apple just briefly as well. In FX at the moment, the euro 109.54, the euro trying to bounce, a bit of strength there. Had a bit of dollar strength to start the year. Some weakness this morning, the euro 109.54. Positive on that currency pair by 0.3%. Let's talk about Apple, which was talked about yesterday following a downgrade from Barclays. This morning, the downgrade from Piper Sandler and Harsh Kumar, a downgrade to neutral from overweight. The stock is down by 0.7%. Every analyst has their view. It's worth talking about the history of Harsh Kumar over at Piper Sandler. A buy on the stock, Lisa, since spring of 2020. Buy. And guess what? For good reason, because this stock has basically tripled since then and now turning neutral.
To me, it's fascinating to see this sort of pile-on that happens as people realize maybe after it's rallied 50%, it's getting a little bit difficult to justify the multiple given the fact that sales are slowing. I will just say that since December 28th, shares of Apple are down 5%. It doesn't sound like so much, but in dollar terms, for a $3 trillion name, that's massive, and it's going to have some pretty big
It's legitimately statistically massive in that it's 5 standard deviations from +2 to -3. I want to point out that sell-side houses have a heritage, and Piper is different than any other bank out there because they had Gene Munster, iconic, years ago. And to go from Gene Munster's expertise on tech over to Kumar has a certain weight that makes people either bullish or bearish on Apple lean forward and read.
Agreed. And the line from them this morning, valuation concerns and broader handset and macro weakness in the first half of 2024. Apple this morning, negative by 0.68%. Under surveillance this morning, Fed officials agreeing last month that it would be appropriate to maintain a restrictive stance for some time. December's meeting minutes saying, quote, many participants remarked that an easing in financial conditions beyond what is appropriate could make it more difficult difficult for the committee to reach its inflation goal. Focus now turning to weekly jobless claims due out in about an hour from now, and then onto the payrolls report tomorrow morning. Lisa, that was the quote that jumped out for me, for you, and basically everybody else as well. Is that pushback from this Federal Reserve against what we've seen over the last 3 months?
That seems to be maybe on the edges what people are talking about. Torsten Slok discussed this yesterday of Apollo, where he said basically you've had a dramatic easing in financial conditions, which may force the Fed to hold rates higher for longer, because essentially the market's already given a couple rate cuts, right? That's essentially what we've already seen.
I saw several quotes that were good, a few of them worthless, and then I went to the one that John went to, where many... What in God's name is many?
Just for the record, he did actually read the minutes yesterday. We talked about it on the phone in the afternoon. I was shocked, but it happened. Let's go to the next story. Tensions building in the Middle East after nearly 100 people were killed in a blast in Iran. 2 explosions targeted a crowd marking the death of a top general killed by a US drone strike back in 2020. No group, Tom, is taking responsibility for the blast. The US State Department saying it has no reason to believe that Israel was involved.
We talked to experts here. Greg Valliere with us moments ago, making very clear it's front of mind for him this morning. Every other topic is pushed aside, but what we witnessed in Iran.
Lisa, you raised the question. To your point, kind of confusing what took place in the last 24 hours, trying to work out what was behind this.
Even Iranian officials are not putting blame on anyone in particular, though implicating their conflict with Israel. I will just say there's been a little bit harder of a rhetoric coming from the White House recently, having to do with the Houthi militants, having to do with connections with Iran, having to do with their patience running out. And Tony Blinken is heading back to the Middle East the next couple of days, yet again, for another tour to try to coalesce some sort of group to counter this. But it does feel like things are just simmering at a bit of a higher level.
I've completely lost count of how many tours he's already done.
I know, that's what I was thinking.
The amount of aggressive diplomacy, intense diplomacy we've seen led by Blinken, Secretary Blinken, over the last few months has been quite phenomenal. Your final story this morning, this one, a showdown in Washington. Donald Trump asking the Supreme Court to overturn a ruling that would bar him from the presidential ballot in Colorado. Trump warning the Colorado decision would, quote, likely be used as a template to disenfranchise tens of millions of voters nationwide. That is according to a copy of the filing, Tom, seen by Bloomberg.
Yeah, I don't know what to make of this, in the sense that there are other states right now considering this, and that's the important point to me. So we have 2 states, Maine and Colorado, front and center. I believe my math is that means 48 other states haven't made a decision yet. Where's that tip point? Is it 2 states? Is it 4 states? Is it 14 states? I don't know.
How immune have people gotten to legal issues involving Donald Trump? I mean, every time something comes up that's legal that has to do with Donald Trump, initially people were saying this is going to be massive, and now it's sort of like, well, it'll be another fundraising opportunity and a discussion about what free elections are. Seriously, though, this is the reason why people aren't even looking at this, because otherwise it looks like he's poised to win the nomination.
And now is the time of the new year where we find the one guest who knows I screwed up biggest, and that is Winnie Caesar, global head of strategy at Credit Sites, that wrote a research note that said the triple leveraged all cash fund was the single worst investment of 2023. I love your note, Winnie, on cash. Everybody was in cash, and you say that was the worst investment of last year. Why?
Well, it wasn't quite the worst. You could have just been in long end treasuries, which would have done a little bit worse than just being in cash. But if you were overweight cash and underweight risk, then you've seriously outperformed. We had the S&P up almost 24% last year, recouping all of those 2022 losses. U.S. high yield and leveraged loans up about 8.5% last year, even in investment, or 12.5% last year, even investment grade up 8.5% last year. So cash looked great at 5%, but other stuff looked a lot better.
Do you and Credit Sites predict that the trillions of cash will move this year and benefit your bond world and also the equity world?
Indeed, we do. We saw over $1 trillion flow into money market funds last year. So that is the cashing up of investors in corporate America as well. And we did see some fits and starts with some of that money market inflow actually coming into spread products, including during December when we saw that massive rally driven by the Fed chair's kind of a new tone on policy and a little bit of a pivot. And that drove a massive rally across risk products, including credit, including equities. And that was just a small drop in the bucket of all of the cash that is on the sidelines. So we don't even need to see, you know, 100 billion of money market outflows coming into other products to have tremendous supportive ability for risk assets, including corporate credits, but kind of a slow drip as investors anticipate lower cash yields is going to be a tremendous backstop.
Winnie, you were bullish on credit last year, and that was the right call to make, particularly even lower rated credit. To start this year, it's been pretty brutal for that in addition to other risk. We've seen an increase in high yield bond yields of almost 0.5 percentage point over the past couple of days, trading sessions. Do you feel like this has some legs, that we're going to see an ongoing sell-off in credit after people readjust from the fervor of the last 3 months of the year?
Yeah, Lisa, I think that that's a great point. We had that tremendous rally in December that pulled forward a lot of what we had expected to materialize in Q1 of 2024 from a performance perspective. Now investors are looking at valuations. They see spreads are quite tight. In fact, we're almost to our year-end 2024 spread target for investment grade. We're through it for high yield. Bond yields are starting to rise again. We have a very heavy new issue supply calendar. And investors are saying, whoa, 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 maybe we don't need to go all in the first week of January. We can take our time. We can see how earnings play out. We can see how all the political consternations with debt ceiling with budget negotiations are going to play out. And we can be a little bit more prudent in terms of allocating capital and not feeling like we have to be in it right away, given how tremendous that December rally was.
Can we just talk about financial conditions, Winnie? Because we've been saying that that was one of the most notable aspects of the Fed minutes yesterday, was that they suddenly seem worried about the easing in financial conditions over the past couple of weeks. How much have we seen the environment for funding for companies really get better over the past month?
So this is an interesting one because the environment from a borrowing cost perspective has improved a lot. Yields are much lower than the recent highs. So we've improved borrowing costs for U.S. investment grade by, call it, 50 to 150 basis points, depending on the issuer and where on the curve you are. And for the high yield market, kind of similar. We've seen a tremendous decrease in borrowing costs. Now, that being said, at the same time, investors are actually demanding pretty healthy new issue concessions. So they're not just closing their eyes and buying whatever is coming to the new issue market. So there is that level of scrutiny going on currently, which would indicate that while financial conditions have gotten better from the issuer standpoint, it's not necessarily this kind of bonanza of we're just going to buy everything.
Winnie, we've got to leave it there. It's good to catch up. Winnie Caesar there of Credit Sites. Happy New Year as well. I appreciate the update and the insight from you. Spreads have been wider over the last 3 sessions. It's worth going through it, Lisa. And they're not exactly small moves over the last 3 days. It's something like 40 basis points wider on high yield. Still incredibly low levels to get that at around 350, but certainly a move in the last 3 days.
And talking about the sort of discussion around 60-40 and how it's been positively correlated, spreads and benchmark yields have been also positively correlated. Yields on treasuries have gone up. So too have yields, have so the spread product, the extra yield over benchmark rates, that also has increased, meaning that the risk has increased to the funding picture of some of these companies. That's a massive move at a time when companies are going to have to start refinancing at some point.
It's worth repeating. We've seen a major move in the other direction over the last few months. But Tom, the risk coming into this year, the pain trade, so to speak, is that the boat has become all the way to the other side. So one-sided now, so to speak, in the last 2 or 3 months, which is why people like Jim Bianco of Bianco Research, Max Kettner of HSBC are talking up the pain trade potentially being this year one of repricing rates higher all over again.
Yeah, I look at the full faith and credit debate and all that, but to Lisa's world and the way spreads have widened out against what, say, Max Kettner's talking about, I'm baffled by the issuance, the Bloomberg Intelligence, Joel Levington. I mean, I'm looking at the bond ownership of Apple, 4.4%. That's absurd. I mean, I didn't even know what to do with that.
Well, Apple is not Walgreens, right? I mean, this is sort of the issue right now that you're dealing with. How do you deal with some of the lower-rated companies? And that's why the discretion is interesting. There still are deals getting done, though. This is going to be the year where people are actually going to get deals done, even at higher borrowing costs.
The year they might have to get some deals
Correct.
done. That's the important point here. They might have to, given the maturity wall on the horizon out there. If you are just joining us, welcome. Just to get you up to speed on some of the price action, we are firmer here by 0.1% on the S&P 500. Just a little bit higher after 3 days of losses. In the bond market, yields higher by 3 or 4 basis points, 395.17. We need to talk about some losses beyond tech. We need to talk about the airlines. American Airlines, 7-day losing streak. Lisa, some strength November through the bulk of December, then some weakness really kicking in for the airlines.
And how much does this have to do with oil prices? And I say this around the margins. Yes, it's also people pushing back around the margins and domestic travel really struggling, particularly in the U.S. But it also has to do with oil prices. And you think about how much of a gift they've been given by the decline in crude last year.
It's been a gift. There's no question about that. But what I see is shockingly low airfares as to the high fares of months ago. Stephen Trent, I believe, scheduled to be with Citigroup today to give us an update on it. He's got some enthusiasm, as well.
He's going to join us next, Tom. Steve Trent of Citi on the airlines in just a moment. And coming up a little bit later, this conversation will continue on the bond market. Going into some key data about 32 minutes away. The ADP report, 15 minutes after that, you'll get jobless claims in America at about 8:30 Eastern Time. From New York City this morning, good morning.
Let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Consumers may start to pull back. We had tremendous spending over the holiday season, but we think that that might be the last hurrah for especially the consumers lower down in the inflation quintiles. Our research has shown that the upper quintile cannot make up the difference for the bottom four. So we think consumer starts to weaken here, and so that will pressure revenues.
That was Tracy McMillan there, the head of global asset allocation strategy at Wells Fargo Investment Institute on the consumer. A weakening consumer could have a big impact on the airlines. A rough final week of the year for the sector. Shares of American falling for 7 consecutive days. JetBlue down for 5, Southwest for 3. But Steve Trent says American Airlines analyst over at Citi is still optimistic, writing this: premium economy traffic flow, international momentum, and loyalty and co-branded card strength should continue to support network airline revenue. TK, that is the constructive view from Steve and the team.
Mr. Trent owns the high ground on this. You do this with the grind at Stuyvesant, then on to Pennsylvania. Then you go north into the middle of nowhere where there's no airports, Tuck. And you go, someday at Tuck, I'm going to be an airline analyst. Trent darkens the door today. Good morning. Great to have you with us here. What's the level of enthusiasm? You have a buy on United. You published that yesterday. People think you're nuts on this. How do you have a buy on an industry that seems so beleaguered?
No, and thank you for having me, and Happy New Year to you guys. I think I have enthusiasm in spots. So when we look at what's going on in the space right now, you're really seeing a lot of the economic value going largely to two airlines, Delta and United, if we're talking about the United States market. You can actually extend this thesis to, let's say, Air Canada north of the border, and let's say further down south, Panama's Copa Airlines, where international long haul is doing well. The network airlines have adapted very well to what I would characterize as the new normal. We have most consumers only in the office 3 days a week. That has resulted in a blended travel, let's say, with very good demand indicators for premium economy. Basic economy is a different story. Pure domestic is also a different story.
Okay, you and I were weaned on this, and the answer is Robert Crandall changed the business years ago at American Airlines. He sat there and said, we're doing price discrimination and that. What our audience knows is tickets are cheaper now than they were a year ago, 2 years ago. How do you have a buy on the stocks if they're giving away seats again?
So I think there are pieces of the space where we're not optimistic. We certainly don't have a buy on the whole group. We're far less sanguine on those domestic-oriented carriers. But when one looks at the supply situation now, if you go back to 2019 and compare domestic capacity versus the U.S. economy, you roughly had $23.20 some odd cents of economic activity per available seat mile. Go to 2023, we had roughly $28 of economic activity per available seat mile. So capacity has grown. The U.S. economy has grown more. I think the argument we're trying to make is not to buy everything, but to be selective in those network carriers that have very specific attributes, such as very strong loyalty and co-branded card. We think that's helped these carriers to de-risk their earnings stream. International long haul, and this very good setup in terms of their cabin offering. Blended travel, economy plus, that's really been the big mover.
How much would oil prices have to rise for you to get less constructive on American?
In terms of Delta and United, those are really the two I like. I'm, less sanguine on the others, quite frankly. I think if oil prices rise, it would really depend how they rise. Do you get an oil price rise because there's better global economic activity? I'm not necessarily perturbed by that, because you have the likes of Delta, Copa, that can price that in to business travelers and higher end travelers. If we get an oil price spike that, crude goes up $20 a barrel overnight, that's a whole different ballgame, which is, I don't see anybody predicting. But if we, in that instance, for example, that's actually a tough situation with the group, because it's very hard to pivot, maybe unless you're Southwest Airlines, and at least temporarily you have a large hedge position.
Lisa has talked about this, the way these airlines are essentially just credit card companies now with airplanes bolted onto them. Who's absolutely nailed their loyalist program when you look across these airlines, these companies? Who's got it nailed down?
Delta's really, I think, head and shoulders above most everybody else.
Why is that, Steve?
So if one looks at their brand, they were thinking back to those, terrible pandemic days. They were the very last airline to finally unblock that middle seat as consumers were just starting to get comfortable again with sitting next to strangers, even strangers wearing masks. Delta is the only major U.S. airline that did not dilute its equity holders during the pandemic. No convertible debt offerings, no equity offerings.
No seats in their lounge. Brammo about fell off her chair there when you're talking up Delta. Give us an anecdote on Delta, Lisa.
No, I mean, listen, let's get the smallest violin possible out. But I'm just thinking, of all of the massive lines outside the Delta Lounge with people bringing their American Express card and pulling it out and saying, but I'm the real guy. I mean, how much is this really going to diminish the people who are loyal flyers?
You know what? And that's actually a hallmark of success right there. So if you look at the loyalty program revenue, they did $4.1 billion in 2021. They did $5.5 some odd billion in 2022. They're probably going to close in on $7 billion. They're going to, I think the print for 4Q is on January 12th or thereabouts. So that trajectory and what they're doing on the co-branded card, they have such a good brand. And for any large bank, they're probably the best counterparty and get very good economics on this program.
Fast forward 5 years from now, how much of the revenue of a delta is going to come from the card effort?
Yes, I think if one looks at the pure economics of it versus just the stuff that runs through the income statement, sort of two different pieces of flow there, I think that, you could have something conceivably 5 years from now that's a good, 10 to 15% higher than it is today, which on the surface doesn't sound like that big a deal. But when one thinks about what kind of margins you get on co-branded card revenue, versus main cabin passenger revenue, the mixed impact is big. The de-risking of the earnings stream is also significant. So once again, I'm not constructive on every single U.S. airline. Sure. There are two I really like, and then I'm less sanguine on most of the rest.
I can tell you the loyalist programs, the actual loyalists, Tom, hate this. The people who actually fly on the planes, they hate it because they believe that if you can acquire the same status just by spending on a credit card, it's just a cheat code. It's not the same as actually being a loyalist and flying every single day on the planes. I know you're one of them. I know a lot of people following this program at home are the same as well.
I'm mixed because on one hand, it's a democratization of a very otherwise sort of gross system where some people are preferred and that are allowed in first and you're better and this and that. Like it's sort of a social experiment when you go to the airport and people start getting angry and start lining up and pushing each other.
To your good point, I had a round trip recently where there was not a single available seat in the lounge, both ways as well. Steve Tron, I've got to talk to you about the dangers that are out there. All of us were just foundationally shaken by what we saw at Haneda in Tokyo here in the last couple of days. I think of Kai von Rumer at Cowen, your great colleague here in the aerospace and airline game, and the dangers that are out there. Kai lived it decades ago as well on an ugly flight. How safe are our runways, with all of your knowledge, all of your intake? How safe are the runways of American airports?
Yeah, great question, and my heart goes out to the folks over in Japan, not just for the plane accident, but the earthquake itself. When one looks at the system in the United States, we have very strict rules here. Very strict rules on air traffic limitations, on how many air traffic movements each controller is supposed to monitor. So I don't have big concerns about the safety. There are definitely bottlenecks out there in terms of the supply of air traffic controllers. And there are arguments that, U.S. air traffic system to some extent is antiquated. That being said, how have officials responded to it? They have forced the industry to reduce air traffic movements in some places. So I think that's unfortunate for the consumer on some levels. But I'm happy to see them doing that in terms of, safety first.
Yeah. Steve, this was great to catch up. Thank you, sir. It's good to see you. Happy New Year. Steve Trent there of Citi. American Airlines, 7-day losing streak. It's been tough. Dream Madison MedLife coming up next.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years, adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg.
The Fed has signaled 3 rate cuts in 2024, but the markets have taken that to mean 6.
If inflation keeps falling, they will deliver those cuts probably starting relatively soon.
We don't have absolute clarity on their reaction function.
It's clear that the Fed pivot has eased financial conditions dramatically.
There is some sort of realization here that maybe we overdid the easing and there could be some near-term volatility on equities.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowitz, and Tom Keene on radio, on television. The narrative continues in extravaganza in this holiday lengthened work week. 8:15 ADP. John claims 15 minutes later at 8:30 we'll have a new narrative at 8:31.
Yeah, claims the one to watch in about 30 minutes' time. 216,000 is the estimate, so that's a little bit lower than the previous week of 218. There's still a big gap right now between what the market is expecting for rate cuts from the Federal Reserve and what the Federal Reserve is implying in their median dot in their forecast. The data is going to take care of that gap as the year progresses. Claims first, Tom. On to payrolls tomorrow. For those that want to know, 171,000 is the median estimate in our survey going into payrolls tomorrow morning.
Everybody's struggling here to find the inflation pulse of America. Drew Mattis will join us here in a moment. That will help. But right now, John, I'm looking at Hesse, Bavaria, Brandenburg, Saxony, Baden-Württemberg. I guess so. German inflation is out. Province by province.
Regional inflation, is that what you're going through?
I'm looking at the regional inflation.
Tom, there's a reason, Lisa, and you know this, why people think the ECB is going to go before the Federal Reserve. It's not just about inflation, it's about the economic backdrop. We are not talking about the same GDP figures in the US as we are in the Eurozone.
What you are seeing is greater weakness and the same disinflation that you're seeing in the United States, albeit different in terms of the components. But this just sort of confirms that, the idea that it rose 3.8%, still above that 2% target, but versus an estimate of 3.9%. Look, a lot of people questioned just how realistic it was for the Fed to cut before the ECB. Now people are rethinking that, right? To what degree does this sort of have a lasting narrative where people go back to thinking the ECB is going to have to cut first and the Fed's going to hold tight?
Christine Lagarde tried to push back in the news conference going into the Christmas holidays. I say tried to push back. I'd say Chairman Powell almost encouraged the rate cut talk. I'm not sure the Fed minutes have clarified that for many other people. I think they've got their views. They're sticking with their views for 2024 and how many cuts we get until this data really changes. wages. But ultimately, Tom, that was the story. Chairman Powell engaged in this idea that they were approaching the point, maybe that point was now, to discuss reducing interest rates. But there is a difference between surgically reducing interest rates in line with the disinflation we've seen, maintaining a restrictive stance, doing that, and starting a big rate cutting cycle and going all the way back to 2%.
I'm going to go back to where a number of our guests are, bringing it back from German inflation back to U.S. inflation. It's about the labor market, two different labor markets. And Lisa, without question, our guests are saying average hourly earnings in this jobs report tomorrow are critical.
Especially because they're not in line with the Fed's projections of 2% inflation. If you still see a 4% year over year, 3.9% year over year wage increase, is that consistent with the kind of ongoing price stability that people are hoping for? It all does deal with the jobs market. And the jobs market right now is shifting, but it's shifting slowly, and that's a hard place to be.
I mean, I'm going to start with the data here, John, to help you out. The euro 109.51. The 10-year German gives me nothing here, 2.10%. I'm getting no drama out of the German inflation.
It's no drama morning, Tom, so far at least. No drama. Some data that might change that in about 25 minutes, but who knows. Looking at the euro, just slightly stronger, as Tom indicated, 109.50, positive by 0.25%. Yields are higher in the Treasury market by 4 basis points, 395.92. And equities, we've had 3 days of losses on the S&P, and we're struggling to bounce, Tom. Stocks up on the S&P 500 by 0.06%.
The heritage here is important. As we talk of, say, Neil Dutta and his optimism, truly one of the economists of the year last year, there's something about an optimistic frame of mind. Drew Mattis showed that with Maury Harris for years at UBS. He holds court now as chief market strategist at MetLife Investment Management. Mr. Mattis joins us this morning. Drew, are you simply optimistic on the American economic experiment?
Actually, you know, we're in the camp that there'll be a recession next year. And so one of the things that I find most interesting, though, is that when I talk about recession, everyone thinks 2008 or 2020. And I think for anyone who's been doing economics for a while, you know, when we think recession, we're thinking more of a normal recession, a 2000 or 1990s type recession. And so I wonder how many of these people in the soft landing camp are going to claim victory if we get a mild recession that's more normal rather than something that looks like 2008.
What will that do to the stock market? Your hallmark is to take economics over to the investment world. MetLife, I mean, I know it's a bond portfolio, it's yield-driven analysis, actuarial assumption, but what does your analysis there mean for equities?
Well, if you're expecting a recession, you're probably kind of migrating or in a risk-off mode. And so, you know, a time for caution. Now, that being said, you know, timing's everything. And quite frankly, you know, people who have been risk-off because they're expecting a recession, you know, have been missing out. And so, you know, I do think, though, one of the interesting things in my mind about the employment report and the inflation dynamics that we're talking about are, you know, last month we had a big drop in the unemployment rate. Inflation's still at 3.2%, and everyone's talking about like, oh, they'll cut less. You know, that's not an environment. If the unemployment rate keeps moving lower and inflation's above 3, you know, we shouldn't be talking rate cuts at all. We should be thinking about whether or not they'll have to restart the rate hike cycle. And so the fact that everyone has coalesced around this idea that inflation's moderating and that the movement in the unemployment rate only really is important if you're worried about a soft landing scenario, I think it's a little misguided.
Drew, you nailed it. You alluded to this. Just a whole generation of investors conditioned by two massive shocks, the great financial crisis and the pandemic of 2020, and the response to those two shocks to take interest rates down to zero. Drew, with that in mind, do you think we've fully shaken off those periods? Because I'm with you. When inflation starts to come down, as you see it in the last few months, when you start to see unemployment maybe creep just a little bit higher and get closer to 4, there is this urge to say, yes, rate cuts are coming back. We're going back to where we were. Do you think we've fully shaken that off in the last 2 years?
I do. I think, you know, if there's one benefit to the surge in inflation we've seen, it's that it allowed us to get off the zero bound. I think you're seeing that globally. It's going to be the one positive dynamic from the high inflation environment we've been living through. You know, one of the fascinating aspects of it all, though, is really this dynamic of, you know, people who haven't experienced a normal recession. And it's trying because, you know, economists are trained in certain ways. We talk about a recession. We think everyone understands what we mean. But instead, they're thinking back to 2008. They're thinking back to 2020. And it's important, there are some similarities. When things break in the economy, they break. So they happen fast. And so this idea that kind of we're going to grind higher in unemployment, usually you jump higher in unemployment and then kind of stabilize around a certain newer level. That's something that I think we have to watch out for. The SOM rule, which I love, if you do it by state, in October, we had like 6 states in recession. In November, we actually went up to 11 states in recession, despite the fact that the national unemployment rate number went down. Now, I know there's a lot of data issues and things like that, but the trend is towards kind of a broadening of the weakening. And I think that's also consistent with the idea that when you look at average weekly wages, something like a quarter of Americans saw their average weekly wage decline last month. That's not consistent with the rest of the movement in the unemployment report that we saw.
If we're talking about a lot of traders who don't know how to deal with a regular recession, how is the market currently mispriced for that sort of more normal circumstance of a downturn rather than something dramatic, cataclysmic like what we saw in 2008?
Well, I think the problem is that they're dismissing kind of the normal recession and just assuming that it will be a soft landing because they don't see the signs of stress that would be consistent with like a financial market recession. And so there's almost an overly optimistic tone because people are looking at data that maybe is not particularly strong, or in the case I just mentioned, the unemployment rate is dropping and inflation is still above 3, and everyone's talking about how many rate cuts we're going to get next year. In any normal environment, if the inflation rate was above 3 and the unemployment rate's dropping or continues to drop, let's say on Friday, the tone has to change from the Fed in that scenario. You can't assume, the Fed's not going to be able to assume that the unemployment rate drop is going to stop. And so then they have to worry about a tightening labor market. They have to look at that average hourly earnings numbers, which are not particularly great for the inflation outlook. And they have to really think about, how, do they have inflation contained, or, did they get the low-hanging fruit and the rest of it's still to come?
If that's the case, do you think that the rotation into consumer cyclicals that we saw at the end of last year and small cap stocks was misplaced, and that those are going to get punished as we head toward what you say are signs of a more normal recession?
Well, as I said, if you're looking at a recession, you should be thinking more in a risk-off mindset, right? There's always opportunities in every asset class, no matter what the conditions are. But broadly speaking, if you're expecting a recession, you're expecting an increase in unemployment, you're expecting some firms to actually fail, some defaults to occur, et cetera. That's more of a risk-off environment, and that's more consistent with different asset classes.
Drew, I remember you said something in the last 10 years, maybe 8-9 years ago, when you and I were talking, and you said something like higher interest rates may actually be the solution to the low growth, low inflation story we were stuck in at the time. We've got an experiment now, we've got a case study, if you will, Drew, over the last 18 months. What are you seeing take place with that in mind?
Well, so I think you're seeing a normalization of consumer behavior. So, one of the problems you have is that if you push the investing rate too low, what happens is that people who are saving, what are they saving for? Primarily, most Americans are trying to save for retirement, right? From the time they enter the labor force to the time they leave it, they're trying to save for retirement. And if you have a 0 rate and extraordinarily low 10-year yields, people actually have to save more rather than less. There's an optimal rate for everything. And the optimal rate for 10-year, for the 10-year note, in terms of minimizing savings, is about 4%. That's where you want it to be, where people actually feel incentivized to save, but they're also maximizing their consumption function because they feel like they're getting a good enough return that they can continue to save for retirement. And we are seeing the experiment play out, and I think you're seeing positive dynamics around the world everywhere where rates have moved off the zero bound. It shouldn't be surprising to anyone that kind of thing is occurring. Abnormal rates lead to abnormal responses on the part of consumers and other actors in the economy.
Drew, thank you, buddy. Appreciate the clarity. Drew Manister of MetLife. Happy New Year, Drew. It's good to catch up. If you are just joining us, welcome to the program. Your S&P 500 just about unchanged. We're positive here by 0.04%. We are about 3 minutes away from the ADP report, Tom. Then it's on to jobless claims later this hour.
Long ago and far away, Drew Mattis said, guess what? Weekly claims matter because they're weekly. It is one of the few pulsing data points we get. I have trouble with it because to me it's asymmetric. It's just about claims where maybe JOLTS and others are more symmetric. But The bottom line is, boy, is it frequent data. And Mr. Mattis years ago said that matters.
I've been a broken record this morning, and probably every morning, but I'm talking about incremental data and the idea that we're seeing just sort of incremental shifts upward in the initial jobless claims.
Yeah.
So is that normalization, or is this something that we should be concerned about? I don't know. I mean, and the market's not sure what to do with that.
I'm glad you brought this up. We touched on it hours ago. The answer is, on a probabilistic basis of 30, 40, 50 people, guess what? There's just this jumble of narratives, and we've just shifted and into the Friday. McKee knows this better than we do. There's just been this shift. Who knows? I have no clue.
I remember,
no clue.
I'll say this.
Ian Lingan.
I remember early December sitting around this table with you and saying, what's the difference between a welcome easing in the economy of the labour market and an unwelcome deterioration? And I was thinking, are we close to that inflection point where it started to become that unwelcome deterioration, and then claims dropped to 203? Claims dropped back to like 200K again. We're still right in and around those kind of levels, Tom, which historically exceptionally low, exceptionally low.
To me, it's just an absolutely unique economy off the pandemic. And one answer is there's a new productivity out there we don't understand, and we may not understand it for 10 or 20 years.
Here's the next 20
we'll
minutes
still be around
on Bloomberg. Stay tuned for this. Carl Riccadonna of BNP Paribas to break down the ADP report and jobless claims. Mike McKee's going to be around the table in just a moment. From New York, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
The challenge here for the Fed is that they still want to have the soft landing, and we all want to have the soft landing. That would be the best outcome, of course, from so many dimensions. But what is beginning to matter is that they have now sucked so much liquidity out. We've gotten to a point where we are beginning to see some strains in the plumbing.
That was Torsten Slock of Apollo. Looking ahead to the data, payrolls tomorrow morning. We just got the appetizer. Mike McKee, an upside surprise on the ADP report.
Yeah, who ordered the supersize? 164,000 jobs, according to ADP, were added to payrolls in the month of December. That's well above the 125,000 that had been forecast. They revised down last month's number from 103 to 101, but they don't match up very well with what was the Labor Department's number last month, which was 150 for private sector jobs. So we'll see how this turns out in the long run. It looks like payrolls largely grew in the service-providing industries, which is kind of what everybody expects. Education and healthcare, 42,000, according to the ADP numbers. Leisure and hospitality, 59,000. And those have been the areas that have been growing on a regular basis each month. They are generally lower paid, but we are seeing, according to the ADP pay growth numbers, only a slight decline in annual pay change, 5.4% down from 5.6% for those who stay in their jobs. Job changers, 8%. So a stronger than expected ADP report. I'm going to go with Lisa's analysis. Like, what do we do with this? I don't know.
That was basically Pramo's response to this in the commercial break.
Bloomberg surveillance, always a value ahead.
164 the number, 125 the estimate. Here's the price action off the back. Just a collective shrug, I think. What do we do with this? The equity market on the S&P 500, basically where it was, positive by almost 0.1%. Yields near session highs. For whatever that's worth, we're higher by, let's call it 3 basis points at the front end of the bond market, 435.96 on a 2-year, on a 10-year, getting closer to 4% here, Lisa, up 5 or 6 basis points, 397.
It's just basically leaning into this idea that maybe the big risk factor is that the economy doesn't slow down as much as people had expected, and that we don't get as much of a disinflationary force from things like a softening labor market. This sort of speaks to that, but you're right. That was my first thing. What do we do with this? Because it's sort of unclear, the correlation between ADP and non-farm payrolls. It's sort of unclear. Yes, we know service sector is hiring much more than manufacturing. Manufacturing kind of flat on its back. So, okay.
Yeah, okay.
I don't know. How do we...
Economists on Wall Street everywhere just sort of writing that headline.
Well, it's not just ADP's fault in the sense that...
No, I'm not saying that it is.
Because...
Well, Mike McKee's going to defend him now, so give him a chance. Right?
Well, I don't know how much of this is a defense, but the issue has been for people on Wall Street and for economists is how fast can job growth continue to be and inflation still come down. So the whole Phillips curve debate is still underway, and it looks like Phillips is losing at this point. So if ADP comes in strong, that doesn't necessarily mean things are bad for inflation.
What's the value of claims? You were talking about Drew Mattis years ago lecturing me on the weekly value of claims. Does that still hold true in 2024?
Well, on a trend basis, it sort of does. We'll get that at 8:30, of course, and it does suggest that at this point we're not seeing any kind of real deterioration in the labor force. The number we're going to want to watch, though, is for tomorrow is the claims number for the survey week, which includes the 12th, came out on the 15th, and that was 206,000, even lower than where we are today. So it all points to a fairly strong report tomorrow.
Mike McKee, stay close. Jobless claims about 10 minutes away, 9 minutes away. We're looking for 216, as Mike mentioned. Payrolls coming up tomorrow morning. TK, the estimate there, 171,000, the median estimate in our survey.
A 3-day extravaganza into 2 days. It's a holiday lengthened work week. Carl Riccadonna knows that, chief U.S. economist at BNP Paribas. We're going to squeeze it in right now. ADP, then claims, and then on to the jobs report. Carl, what matters among these many reports?
I think what matters, first of all, Happy New Year to the surveillance team. I think what matters in the labor data is kind of the interesting nuance in the details. And that is that I think the labor market dynamics we're grappling with at the moment as we eye soft or soft-ish landing type of scenarios is that there's a real distinction here between rising layoffs and a lack of hiring. And it seems like the latter, that lack of hiring, is really what's driving the labor dynamics at the moment. We saw that in the Challenger layoffs data earlier today and also in the last several months. That's why jobless claims are kind of trending sideways for a very extended period of time and not giving us a lot of forecasting information for non-farm payrolls. And rather it's just a reduced appetite to add workers that seems to be driving the labor market dynamics at the moment.
Which is the reason why JOLTS data yesterday, in particular the quits number, was interesting because it kind of confirms that employees are feeling that they don't want to quit so quickly because it's not clear who's going to hire them on the other side. What does that signal to you in terms of whether this is an inflection point to something that's just sort of a little weaker rather than something that could accelerate more significantly with greater weakness?
I think the trend in the JOLTS data, the quits rate in particular, openings to unemployment, all of this signals that there's a great normalization happening at the moment. So I don't think, Lisa, you mentioned inflection point. I don't think we're at an inflection point at the moment. In fact, if we look at the hiring trend, it's been a very linear trend since the start of last year for for more than 12 months now, just this very linear fit. If we look at a 3, a 6, a 12-month moving average on payrolls, now there is a slope to that line and it's aiming lower. So there is a hissing sound in the labor market. We're losing altitude, I think to the tune of about 15,000 per month on non-farm payrolls, if we look at that kind of broad trend. But that's an extrapolation of that linear trend, so that's just more normalization. That's not getting to that inflection point where things suddenly break down. That could happen in the first part of the year, but I think that it's going to be a few more months before we start to think about that inflection, because after all, if we're looking at non-farm payrolls averaging in the vicinity of 150 to 200,000, that's still a very healthy income and wage dynamic for the economy. So that would provide a big buffer against that non-linearity developing.
Carl, can you help me out? Because when I got the ADP number, when we all got the ADP number, I just didn't really know what to do with it. What do you do with this?
Well, I think we look at the composition of ADP, whether we're looking by firm size, which we've really seen really a concentration on kind of middle-sized firms contributing to job gains over the last several quarters, actually. That factors into the diffusion of job gains, which was something Mike McKee highlighted just ahead of me. And when we look at the diffusion of job gains in the economy, this is often the canary in the coal mine, so to speak. In the diffusion of job growth, last month excluded, has been continuing to deteriorate. So this again signals that the labor market is firing on fewer and fewer cylinders. Now there was a spike in diffusion last month, but that was the end of the auto strike and tangentially related industries, getting those workers back and resuming production. But that longer-term deterioration in the breadth of job creation is something that disturbs me, that potentially could point to the soft landing being a bit more soft-ish than just soft.
Just to build on some of that, Carl, just quickly, because we'll get claims in about 5 minutes. You're kind of going to stand by and break that down for us alongside Mike McKee. Carl, is there a number on claims, a line in the sand, so to speak, where you start to get concerned? 250, 300, where things start to break out a bit?
I think if we start to see kind of a 15 to 20% increase in initial claims relative to, let's say, the trailing quarterly average, that's when I start to get nervous. Now, mind you, the claims numbers are at extremely low levels, so kind of the, that gives you an easier path to a big percentage increase. But we need to see a sustained pickup in claims, not around holiday weeks and the turn of the year and whatnot, when there's often a pickup in volatility. But on a sustained basis, you need to see that pickup. On the continuing claims, there seems to be some seasonal adjustment issues, so I treat that skeptically.
Carl, stay close. We'll break it down in just a moment. Carl Riccadonna of BNP Paribas. Jobless claims coming up next. Your estimate, 216,000, following an upside surprise on ADP. Equity futures just about unchanged. From New York, this is Bloomberg.
is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Jobless claims data just seconds away. Mike McKee around the table to break that down. Carl Riccadonna of BNP Paribas ready to respond to it. That data just seconds away with your equity markets shaping up as follows. On the S&P 500, positive by almost 0.1% on the S&P. Yields higher by 5 basis points on a 10-year, 396.48. Following an upside surprise on the ADP report, 164,000, the estimate 125. Claims data. Mike McKee, there's your downside surprise.
There's your downside surprise, which, you know, this is the number that is supposed to be better if it's lower. 202,000, down from 218. That was the prior number without revision. Continuing claims, 1,855,000 down from 1,875,000. So better news all around in the claims numbers. Now, I'm going to put in the standard economist disclaimer for this time of year that holidays distort the seasonal factors and it can be difficult to get an accurate read on where we are. But in general, you're going to say, looking at these numbers, that not much has changed in the labor market. And again, I want to point out the survey week, the week that includes the 12th of December, the number was 1875 because that was last week for continuing claims. They're 2 weeks behind, and it was 206 for the headline number. So we are still seeing some enormous progress here. Last week's claims numbers were revised up to 220, which would have gotten your attention, John, I think, if that had been the case.
Exactly.
And instead, we lose 18,000, it goes to 202. But remember, we had New Year's Day, so maybe that.
To your point, it's early days.
Off.
It's one data point. Let's just push it through the bond market. Yields at session highs on a 10-year up 6 basis points, getting closer and closer to 4%, 398, 202. Lisa, if you put this together with a strong payroll report on Friday, then it's going to speak to the Max Kettner of HSBC call, which is that the risk this year is you get a repricing of rates again, particularly if you see more of this. Now, I've got no idea if you're going to see more of this, but certainly that's an early read on maybe what's to come.
That's what I was going to say. Actually, this is getting interesting. ADP followed by this, and now non-farm payrolls next up to see whether we see that strength, the stronger than expected labor market continue to come through. How can you price in 6 Fed rate cuts with hiring at a decent pace, unemployment rates near record lows, not really showing signs of cracking? It doesn't really make sense. And this, to me, is really emerging as the theme, at least of the first week of 2024.
Mike McKee, is this labour market a reason to stay hawkish at the Federal Reserve? Does this lead to higher wage pressure?
Well, it depends on how you define hawkish. If you define it as the Fed doesn't cut interest rates as soon as people think, yes, it probably puts a little pressure in that area. We will not get another payrolls report before the next Fed meeting because it's January 31st. Oh, so this is what they're going to take into the meeting room. If you define it as will they raise rates, I still don't see that. But we'll see what happens maybe with that average hourly earnings and, of course, CPI next week.
Let's get out front of Carl Riccadonna. I got a bigger, broader question for him. Let's go narrow tomorrow. How do you interpret average hourly earnings within the 47 other measurements of wage growth that are out there?
Well, average hourly earnings are telling us that we are not there yet in terms of the Fed being able to declare mission accomplished. Average hourly earnings running at 4% are still too hot for inflation to be sustainably at a 2% run rate, especially as we look at the core numbers. And even more important than average hourly earnings is the employment cost index wage and salary component. That's running at 4.6. It needs to be at 3% or less to be consistent with 2% core PCE inflation. So we are simply, there's lots of good progress. The glide path is looking in the right direction, but there is still further room to run before we can feel more comfortable.
Carl, I got to go to 60,000 feet here. You're really good at this. Peter Drucker, 1991, on the new productivity. Do we have any clue, given our labor data that we're in right now, what the productivity, the efficiency, the efficacy of our labor is? I would suggest we're flying blind.
I think we are still flying blind post-pandemic, Tom, and we've seen some wild swings in productivity due to labor shortages and then the rebound in participation. Lots of kind of wild swing factors are really distorting the numbers. That big surge we saw in GDP growth in Q3, of course, distorts productivity. That's not the beginning of a trend. That was a one-time flash in the pan. We can see that in the tracking forecasts for Q4. So there really is still a lot of instability and noise that we have to look through to get a clearer perspective. Now, what I think does give us some sense of the trend, when we have extended periods of labor scarcity and high labor costs, typically that pushes businesses, encourages them to make the kind of productivity-enhancing capital investments that do lead to a productivity boom. But we're still not out of the woods yet. The labor data does look to be moving to a more balanced state where maybe we have less labor cost pressure 6 months from now, for example. And then that would say maybe there'll be less of a productivity flare-up than we might be anticipating. Of course, AI is a big wild card, but I think it's a little bit too soon to be factoring that into the macroeconomic data on that kind of scale.
If you are just joining the program, would you just get a 1-2 punch, better than expected jobs data with the ADP report coming in hotter than expected, and then initial jobless claims coming in lower than expected? You could see an extension in the move with 10-year yields now creeping closer to that 4%, 3.99% if you round up, about just less than 1 basis point. Carl, how much are you looking at a market that is screaming that we are not going to have any recession anytime soon without some sort of exogenous shock?
Well, I think the market signal is very important, but that market signal will be very subject to the macroeconomic data trend, and we are certainly moving to a slower pace of activity than where we were, for instance, in Q3 of last year. So it is a slower profile in the first part of this year, which will mean less hiring. That puts pressure on margins and revenue gains and whatnot. If there's slower nominal GDP, then those things tend to slow down as well. So it'll be a challenging macro environment, which will be an environment in the first half of this year where the macro variables really do drive the narrative, as we'll get some clarity on whether it's a bumpy landing, soft landing, no landing, et cetera, et cetera. And so I think we do have to, pay very careful attention to that tug of war between what markets are seeing in terms of Fed easing and whatnot, and what the macro data are suggesting. And as we look at the claims numbers, right, this is consistent with what we said ahead of the data, which is it's not layoffs that are cooling the labor market at the moment. It's just a reduced appetite for hiring.
You mentioned the market signal, Carl, and I think that really follows nicely onto what we saw yesterday in the meeting minutes. Jay Powell kind of dismissed this idea of financial conditions in the December FOMC meeting, and then he inserted that back in, or somebody did, in the meeting minutes, where suddenly they're worried about this easing in financial conditions. Do you think that basically the implied rate cuts that we have seen priced into the market through the end of last year have made it more difficult to really achieve that price stability in a way that we see with ongoing labor market strength?
I think that the easing of financial conditions, which is pretty substantial, our own BNP Financial Conditions Index would say that the moves from the highs are equivalent to maybe 100 basis points of Fed cuts. that complicates the exit process. Now, the Fed knows full well that when they shift from the risk of there being more hikes to either being on perma-hold or moving to a lower policy rate, that there's always going to be that kind of easing of financial conditions that takes place. But absolutely, this does complicate the process. We heard that in the minutes, the line that said, the easing of financial conditions, the scope or the magnitude of it could jeopardize the Fed's path. If we have a real reacceleration in the economy, then that last mile in the inflation fight becomes more difficult, and that's going to slow down the Fed in that process. What I thought was interesting in the minutes was usually the Fed has the boilerplate language. If it's hotter, we'll go higher. If it's cooler, we'll go lower. And they didn't do that. It was, I think, on page 8 of the minutes where they talked about, kind of maybe empty or somewhat empty rhetoric about saying that, there's a possibility of more hikes. Then they went on to say there's a possibility that we could take longer to pivot towards cuts. But they never then added the other side of the scale, which is, and if things are cooler, we could go sooner. So that tells you they're very sensitive to the market reaction to the December press conference.
Carl, the fact that we were all wrong last year and that we got this wonderfully buoyant economy, and right now, John, a 3.8% statistic on the unemployment rate guesstimate for tomorrow. Carl, are we fully employed? I mean, there's a lot of Americans flat on their back. But are we fully employed in America?
As we look at the aggregate data, right, the unemployment rate below 4%, if we look at the wage trends, I think it's pretty apparent that we have been in a period of full employment, and that largely explains those wage pressures. Now, the labor market is cooling, so while we may be fully employed now on the eve of the December jobs report, by the middle of the year or later, I think that there could be a hotter debate about whether we still are at full employment, because we will see those wage pressures coming down as the unemployment rate drifts higher, and that will create some slack, which is a welcome development after the last 2 years post-pandemic environment to get us that last mile back to 2%. Of course, full employment is very important, but as Jerome Powell reminds us in nearly every press conference, right, price stability is the bedrock or the foundation of a stable economy. So we can't just push the unemployment rate as low as we can go without taking into consideration that trade-off with the inflation dynamics. And that was actually something that was highlighted in the minutes yesterday as well, where now policymakers are starting to think about the trade-off on the dual mandate. So there's more weighting to both factors on the dual mandate relative to where we were over the last several quarters.
Hey, Carl, just quickly, just to recap, expectations tomorrow. What are the numbers for you and the team?
Well, I'm eyeing this hissing sound in the labor market. We're gradually losing momentum, so I think 165-ish on the number, which now turns out to be just slightly below the consensus forecast, and I would watch for some slack in the unemployment rate. I actually think maybe a 0.2 increase up to 3.9%, with still those persistent wage pressures in the background. Keep in mind, inflation is a lagging indicator, and so is labor inflation.
Carl Riccadonna, appreciate it. Happy New Year, sir. Carl Riccadonna of BNP Paribas. One eye on this one. The 10-year, really close to 4%. High of the session, 399.50. Right now, about 399.30 off the back of the upside surprise on ADP and the right kind of downside surprise on jobless claims just moments ago. Bramo, 202 on claims going into payrolls tomorrow morning.
All right, if we can coin a narrative for 2024, just based on the price action of a couple days of 2024, it would be that people got a little over their skis in terms of the potential disinflation and the weakness in the economy. The ongoing strength in the U.S. economy and labor market has been remarkable, and we get that again today in the economic data.
If you are just joining us, the S&P 500 turning negative off the back of some of this. We're down by 0.1% on the S&P 500. That follows 3 days of losses on the S&P, 4 days of losses on the Nasdaq 100. And I want to return to the quote that we got from Max Kettner of HSBC, published yesterday. We continue to believe that from a multi-asset perspective, the biggest risk is not from a sudden deterioration in earnings or activity, but another repricing in rates. And TK, as we commence a brand new trading year, and start 2024. We're very, very close to that repricing right now.
Yeah, I think the repricing's happened quickly. And again, in Apple, we saw it across 5 standard deviations, +2 to -3. Pushing back against a lot of the caution out there, Gina Martin Adams of Bloomberg Intelligence on equities was blistering yesterday over the guesstimates, the certitude that earnings will come in short. And she said the fact is, in the cycle where we are, you do get out to high single-digit, double-digit earnings growth. I'm not hearing enough about that right now.
Mike McKee, got about 45 seconds. Final word on the data.
Suggests that we are at least in status quo, which for the last couple of months has been very good news for the overall economy because we're not seeing inflation rise, but we are seeing employment still stay strong. And that's what the Fed and the soft landing people want to see.
The payrolls report tomorrow morning, 8:30 Eastern Time. The estimate in our survey currently 171,000. The data so far so good on the ADP report and on jobless claims as well. Coming up on this program, you can't say the same thing about the auto sector in this country right now for GM or for Ford. The latest with Bloomberg's David Welch on the auto industry. Up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
Beyond BYD, beyond Tesla, how much of a reality check are we getting for the industry, for the likes of GM and Ford?
I think a big reality check. That's why you've seen Farley, I think Mary, they pulled back, in terms of a bit from the EV strategy in Detroit. And the problem here is, do consumers want EV or they just want a Tesla? No doubt there's been, I think, much more moderate demand that we're seeing across the board.
That right there is the question, a question we've all been asking over the last several quarters. Do consumers want EVs or do they just want a Tesla? Much more important question here in America we'll get to in just a moment. Here's the broader price action, a lot to recap in the equity market on the S&P 500 as we go towards the opening bell in about 43 minutes time. Equities just turning negative on the S&P. So we've had 3 days of losses on the S&P 500. Meanwhile, add to it off the back of some data in America in the last 50 minutes or so. Upside surprise on the ADP report, 164, estimate 125. The right kind of downside surprise on jobless claims, 202, the estimate 260. 316, and here we are on a 10-year yield, very, very close to 4% again. Up Lisa by almost 8 basis points on a session to 399.
The macro signals right now are that the U.S. economy is doing really well, or at least staying on trend, and we're not necessarily getting any kind of inflection point, as we were just hearing from Kara Gadana. What I find interesting is some of the micro stories and the competitive advantage that certain companies are having. I just want to take a look at this. Yesterday, Bloomberg reported that TikTok is eyeing a $17.5 billion shopping business on Amazon's turf, and how they're going to really build that out in the U.S. You could see Amazon shares down this morning. Also, TikTok working with Peloton, a U.S. company, to roll out some initiative, and the Peloton shares are up more than 7%. This is just the interesting dance, and it has geopolitical consequences, and it has all sorts of competitive consequences, which really feed into the auto industry as well. Who gets the upper hand at this time?
If I'm on the Peloton bike in the living room or in the back bedroom, that has geopolitical consequences.
It does, actually, because if you think about it, well, you really
they're going to feed you communist propaganda through the Peloton. Is that what happens?
There have been
You're
studies
riding there and you get fed communist propaganda from the CCP.
Look, the question, hold on. There are questions about whether you want TikTok really having as much of an inroad in the U.S., and you have all sorts of politicians talking about that. Meanwhile, they're going to start to try to dominate the Amazon industry of online shipping, and you have, coming into your bedroom to tell Tom how to work out. That has geopolitical consequences.
Try to extend it out beyond 5 minutes. That's the advice from Beijing.
And we're all very excited about this now, Tom.
Yeah, we're all ramped up. Saving us in Michigan, in Dearborn, in Detroit, is David Welch, our Bloomberg Detroit Bureau Chief, this morning. I signed up for this morning. David, I want to look at the gross business here. Under 16 million unit sales this year. I guess it was a pretty good year. I go to the screen and I basically got the typical small foreign car, $28,000. I look at some kind of fancier U.S. car, $10,000 more. How does price play into the auto business in 2024?
Right now, it's everything. You've got high interest rates. You still have even though sticker prices have come down, the average vehicle's around $48,000. That's very expensive. That means you've got payments well over $700 a month, which means that you've got, these are affluent people buying new cars right now. It's not really a thing for the poor, certainly, and even middle-class people struggle to buy one. We did see some big gains in the quarter. Things like Nissan Sentra, Nissan Kicks went up pretty nicely. GM's done pretty well with the new Chevy Trax. These are vehicles that sell in the $20,000 to $30,000 range. Those are pretty affordable for people.
Right.
And so the companies playing down in that range can get some buyers because there aren't that many affordable vehicles.
David, let me go back to first principles. My first interview with Bloomberg ever was a guy named Rick Wagoner, who ran a small auto company in Detroit. I'm going to ask you the same question I asked him decades ago. It's just real simple. Why can't we build a cheaper car to compete with the rest of the world?
The companies can. I think they've just gotten away from it because the profits aren't there. They have to, you take the Chevy Trax, I give GM a bit of credit here because they really have tried to come up with a vehicle that can sell for a little over $20,000 and appeal to that entry-level buyer. But they build it in Korea. They don't build it in the U.S. The other automakers will build those vehicles in Mexico. The profit margins on those vehicles are so thin that you do need to shave every bit of parts and labor savings that you can in order to try to make a buck on them. And often they're basically just vehicles to get people into your brands, hoping that they'll have a good experience and graduate onto something bigger, pricier, and more profitable later on.
David, let's ask the question that Dan Ives asked himself just yesterday. Do consumers want EVs, or do they just want a Tesla? What's the answer to that at the moment?
Well, look, third quarter EV sales in the U.S. were up 50% year over year. Tesla's EV sales were not up 50%. So that means somebody's getting the above 30 whatever percent it was. I think that Tesla grew in the quarter with its total sales. So yeah, they do want other people's EVs. The numbers aren't very big right now, and that's why the growth rates are higher. So the problem is the other companies' EVs are things like $80,000 F-150 Lightnings and $60,000 Cadillacs. And they're just, Hyundai and Kia do pretty well with them, but they're not cheap vehicles either. Prices are still too high for the non-Tesla EVs, and the charging network is still not there. getting better. The deal with Tesla, where everyone's going to be able to piggyback and use their charging network, will certainly help. And the investment by 7 automakers to build out a network also will. But none of that's really, taking hold and in place yet. As it does happen over 2024, people will see more charging stations and maybe have confidence to buy. But it's still price, variety, and charging network are holding back the mass market buyer from going electric.
How many of these cars are still eligible for tax credits? David, you alluded to some of that. You talked about the pricing strategy. How have things changed to start the new year?
Yeah, look, that's shrinking down to, I think it was 13 was the tally. Some of the companies are trying to resource key parts to get them eligible. GM said that the Cadillac Lyriq and the Chevy Blazer, their midsize SUVs or crossover SUVs, both electrics, they should be able to get those qualified in the first quarter sometime by resourcing 2 parts for those vehicles that would get them under the qualifications. And you'll see some of that, but it's dollars from the federal government. I think that a lot of people thought companies are going to have to work to get that money for their buyers.
David, if BYD were able to sell their vehicles in the United States at cost without having to pay massive tariffs, how much cheaper would they be than the average electric vehicle in the U.S.?
Yeah, it's tough to say because one of the reasons the Chinese companies aren't selling their vehicles in the U.S. right now is they're not homologated. In other words, they haven't met the safety regulations. You have to crash a bunch of cars and do a lot of testing, and you have to do emissions testing and that sort of thing. And I'm not sure if BYD's vehicles meet that. Once you do, it does add some cost. And you also, your vehicles have to be roomy. They have to have all the qualifications that American buyers want. That would add some cost. They would still be pretty cheap. BYD has a great cost advantage. Don't get me wrong. It's not the flick of the switch that a lot of people are thinking. But I do think, sans tariffs, they'd be extremely competitive, and it would be pretty scary for the domestic and the Japanese and Korean automakers doing business here.
I wonder how much the price is really what defines whether or not people are buying or not buying right now. Ironically, the more expensive vehicles might have a bigger audience because they'll be the wealthier people who can pay all in cash. How much has the non-cash buyer base for autos absolutely disappeared in the face of interest rates or borrowing costs that are north of 10%?
They haven't disappeared, but it is tougher. And one thing we've seen is leasing is ticking up, and that's a way of getting that monthly payment down, even in the face of higher interest rates. So that's one way to handle that. People are probably putting more cash down. The used car market's still pretty strong, so the trade-in's giving you people a decent, and I mean historically strong. It has weakened, but you're still getting historically good prices for used car. That's good currency to go trade in a vehicle and buy something. But I think one of the reasons that we're seeing a 15.4 or 15.5 million unit market in the U.S. instead of the old days of 16, 17 is because of pricing and cost, and only the affluent buyers can really afford that. And what's keeping the U.S. market aloft is the rich are always with us, but the middle class and poor are having a tougher time.
Here's the inside of the day.
True. David, thank you, sir. David Welch there out of Detroit on EVs. Let's put a bow on the morning. We need to talk about the data out of America. 2 small data points. It's early days. But Lisa, is it the recipe, the early sign of just the drip, drip, drip? The water torture for bond market bulls if you get more of the same. Claims, ADP onto payrolls tomorrow.
That seems to be what the market is set up for, given what the trading was in the last couple of months of last year. What happens if people start to question all of those rate cuts that they priced in, not because of Fed pushback, but just simply because the data is inconsistent with that kind of view?
I look at Atlanta GDP 2.5%, growing America, mint claims, 3.8% unemployment. It's morning in America.
Good morning.
Good morning.
In America. Good morning, good morning, good morning, good morning.
Good morning, good morning.
Good morning.
From New York City this morning. Good morning.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Been so used to the fact that every time there's a problem, central banks come and ease. This has been the kind of playbook, throughout my career, before that, after I left. Now we're in a very different environment. Central banks actually have to create a recession, in essence, to get back to price stability. So it's a complete reversal of the modus operandi, in a sense, of central banks as they've known it for the last several decades. So that's why it's not so much that they're getting something wrong. They've now acknowledged that there is this trade-off, these costs to pay, but it's a completely different way of thinking about central banks, and it's a different role. Another way to put it is they have to be unpopular now in order to get inflation back down, where it used to be you could count on them each time to rescue you, to stabilize the system, to bring support. And that has shifted. And I think many people, even in the markets, have not quite understood, in my mind, how much we are now in a different regime compared to the last 4 decades, effectively.
So it's what, almost an easing bias in the markets? How would you describe it?
In the U.S., yes. And I think it's this idea, this almost pre-programmed idea, when there is a problem, i.e. potential recession, central banks will come and ease.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with the plan.
From New York City, for our viewers worldwide, I'm Menace Cranny in for Jonathan Farrow. The question you need to ask yourself as these futures dip ever lower and yields pump higher, has Goldilocks left the building? The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in today's show, stocks looking to snap. Well, can they? Or will they continue on this losing streak? Jobless claims coming in soft ahead of the payrolls, and the Fed minutes signal higher for longer. We begin with a big issue, looking ahead to the jobs report.
We've got payrolls coming out tomorrow.
Payrolls. December payrolls. The first big test to the market of, okay, if that's strong data, then the Fed can stay on hold.
I think it's still going to be really solid.
Solid, if not strong. Still strong, still solid job growth. Consensus expects about 170,000 jobs.
We're looking at 180.
It's a super tight labor market. There's no urgency to cut rates given a strong economy. The unemployment rate's still really pretty low.
The market might start to think, well, perhaps it's not actually a situation where we will get very aggressive rate cuts.
It's probably a bit too early to be signaling, or at least validating the market expectations of rate cuts as early as March.
We really need to see some evidence of deceleration in the data.
There's a lot of uncertainty.
Could be positive or negative.
There has to be some sort of data reality check for the market.
The key here is job creation.
The jobs market will play an important role this year.
Joining us now to break it down in Council Forward, BlackRock's Amanda Lynham and MUFG's George Gongalves. Okay, here we go. We've got the ADP report that came out, 164,000 jobs. Doesn't look as if we're wilting at the moment, and pay rises are plenty. George and Amanda, good morning. Let's take it to you. We're looking at one of the worst market setups since 1999. Are you shaken or unperturbed? George, good morning.
Good morning. Yeah, look, I think we have to also realize the starting points matter too. Like last year, we finished on a really strong and high note. So market's getting back those gains that were really fueled by lower rates, and now the market's questioning that. I think it's fair game to see the sort of kind of repricing in the first week of January.
And Amanda, to you, I mean, I started the show by saying there's a risk that, of course, Goldilocks might have fled the building. I mean, there's this anti-Goldilocks narrative that is evolving. In other words, that syncopated rise in equities, rise in bond prices, and drop in yields may well be breaking down.
Good morning, Manus. Thank you for having me. I think I loved what you had in the intro about the reality check. I think what this is a course correction from perhaps some over-exuberance in the last part of 2023. And in my market of corporate credit, spreads tightened significantly to levels that were likely unsustainable. And so I think this is probably a healthy correction. We're seeing weakness, but I would say we're not seeing a lot of activity in terms of trading yet in our market, very focused on new issue activity. So we'll see how that plays through. I think as it relates to the data for the rest of the week, specifically non-farm payrolls tomorrow, I think really what the data this morning is highlighting is that there are upside risks still to the economy. And so the market is probably right in calibrating expectations for significant swift rate cuts in the early part of 2024. And I think that that's appropriate.
So Amanda, you would say that a lot of the tightening in spreads was pulled forward into that back quarter. I mean, that happened a lot in the bond market. 100 basis points of a drop in yield. FCON became louche. It's a bit like me in Annabelle's in West London on a Friday night. But a lot of that squeeze was pulled forward. So what happens to credit in this first? What changes the narrative for credit in this first quarter?
I think really for 2024, the narrative for credit is all about the cost of capital and refinancing activity. And I think the positive data point that we've seen is that the willingness of the Fed in particular to embrace a path that they will be normalizing policy in response to declining inflation has been positive for risk sentiment. There's a lot of focus right now on the timing of rate cuts, but what we've emphasized is that the reason for those rate cuts really matters. And so if we're getting rate cuts because of a downturn in growth, that's much less supportive for risk assets. But if we're getting rate cuts, eventually our base case is the second half of 2024 this year. If we're getting rate cuts because inflation is retreating, then that's a much more supportive outcome for risk assets. So I think we actually can have a pretty supportive setup for credit risk, especially for yield-based buyers, because although yields have retreated, they're still pretty attractive from historical standards, specifically in the post-financial crisis era. So I think if I'm an investor, I'm bracing for more supply relative to last year, probably a bit wider spreads, but nothing dramatic, a bit more in default and loss activity, but still pretty contained, and looking for selective ways to deploy risk.
Okay, that's a fairly robust setup. George, let me take it back to you on the equity side, because if we're cutting rates because inflation is well behaved, it's hurrah for risk. If we're cutting rates because we don't get the growth that we expect, and perhaps the soft landing, then that is more negative for equities. So cast forward for me, we've got a bit of a wobble in these first couple of days, but could that spiral into a bear market?
Look, I think this quarter is going to be super critical. Can rates rise for the right reasons? I mean, we have had a massive rally in rates. Spreads have also tightened, as Amanda's been going through, because I agree. But like we moved from like a yield kind of chasing story, and I think the spreads are going to play a critical role even for equities as well. So if spreads start widening in credit, it's because we're worried about growth and just the kind of credit conditions more broadly, which leads us up into the end of the quarter and the bank term funding program, and what will the Fed do with that? So I think the Fed obviously has changed, has pivoted both now on rate policy as well as on the balance sheet policy, as we heard yesterday in the minutes. So something has gotten to the Fed, and it could be that they're trying to soft land us, and they're trying to kind of foam the runway, as I've been calling it for quite some time. We've had a March call really ahead of most people. And I think if they cut then, it could be because they're trying to soft land us, but it could be because we're actually seeing credit conditions worsen, and we have this bank term funding program that's still unresolved.
Yeah, well, we've yet to even have any real turbulence before we roll out the foam, George, so just hold that thought. Let's push it forward on the data front, because jobless claims set the stage for payrolls. Tomorrow, Bloomberg's Mike McKee is with me now. We've had the ADP numbers. Mike, what else are you looking at specifically ahead of the jobs report tomorrow?
Well, all the data is in that would be what you use in a model to try to come up with a number for tomorrow. So we'll watch what the overall number is. It's gone up a little bit to 172,000 from 171 after today's numbers. 164,000, as you mentioned, on ADP. Now, the scary thing about that is ADP over much of the last 6 months has come in below where non-farm payrolls, private hiring has come in. Jobless claims were weak, 202,000, but it is a holiday week, so it's kind of hard to say that's an accurate number. So let's go back to the survey week, the week that includes the 12th, and it was just as low, pretty much. So doesn't suggest that we're going to see a lower number. Manufacturing jobs, while still contracting at a slower pace, and the Conference Board's Jobs Plentiful Index rose during the month. So all signs point to a relatively strong number. Now, what does that mean? Is the labor market running too fast for the Fed? Whoa, Nelly, they might say. Slow down a little bit. You look at the average number of jobs created in 2019 versus 2023, and we're well ahead of that pace. And the same thing holds true for unemployment and for earnings. Unemployment is lower, averaged at least in 2023 than 2019 before the pandemic, and average hourly earnings, as we know, have been running stronger. Where does that leave us? Well, we're expecting a strong report tomorrow, a relatively strong report. But economists do see a change coming. The latest survey of economists by Bloomberg suggests that 2023 average hiring number is going to come way, way down. Unemployment is going to rise significantly, and average hourly earnings are going to fall off. Does that happen, or do the numbers we're likely to get tomorrow call that into question? That's what the Fed's going to be debating as the year goes on.
Indeed, and the strength of those numbers tomorrow will set the table in terms of March rate cuts and the rest of the year. Mike McKee, thank you very much. Amanda Lynham, let's bring it to you. It's not that the 6 rate cuts are off the table by the market at the moment, but there has been a dissipation of conviction for March. My question to you is this: do I push later in the second half of the year for these cuts, and this data our data holds up for the first couple of months here, and it just pushes that narrative into the back half of the year? So it's not that we don't get 6, it's just later.
Right. I think it really hinges on the labor market, Manus. If we're still seeing these upside pressures to average hourly earnings, the employment cost index, if we have an unemployment rate that still remains below 4% for nearly 2 years running now, I think it reduces the urgency of the Fed to normalize policy rates. Our base case is the second half of this year, but we've acknowledged after the December FOMC that the risks to that are clearly skewed earlier. So that's our working assumption at the moment. I do think, though, even if we take the labor market data from this morning in isolation, maybe the early signaling points to a positive report, but I would also point to just CEO confidence and strategic M&A activity that has been rebounding over the past few months. That, I think, is also an indicator of what could be going on in the labor market. And so if we are seeing CEO confidence improve, if you're seeing strategic M&A, which we have been increased back to levels that we last saw in 2020 and 2021 after that wave of COVID-related M&A, that I think is also supportive for probably a resilient employment picture. And so that's something that we're watching very closely in addition to the typical employment metrics.
George, let's just round off the thought process with you. I was just looking at Mike's projections, and he's talking about 4.2% in terms of the unemployment level. He's talking about job creation dropping quite significantly this year, 74,000, 4.2% in the unemployment rate, and wages dropping quite significantly. Does that stack up for a soft landing in your view? And what does that do to risk?
Look, those numbers are averages, right? And we got to be careful with the averages in general, because last year, the second half of the year, most jobs were created by the government and the healthcare sector, and private enterprise were not really hiring. So we have a labor hoarding, almost like a labor freeze on the private sector side. So I better hope those CEOs are as confident as they're suggesting and start hiring people, because it's not coming from the private side, it's coming from the government side. So if you take that and then you look at those averages that Mike put up on the board, those are recessionary type numbers. 4.2% unemployment rate from a low level that we got last year, and only under 100,000 on AFP. Those are mild recession numbers.
Okay, team, stay with us. Amanda Lynham and George Goncalves, my guests this morning on the markets. Let's look at what's under the hood and what will move us at the opening bell. Abigail Doolittle is with me. Abby.
Well, Manus, we're looking at a potential fourth down day for Apple in a row right now, heading into today, headed toward a 5% loss in the first 3 trading days of 2024. This is Piper Sandler is downgrading shares of Apple, adding to the downgrade that we saw earlier this week, a bit of a bearish move here, joining that Barclays downgrade. And they are concerned also about iPhone inventories and demand. So that stock, again, dragging on the futures and down for a potential fourth down day in a row. Walgreens Boots Alliance, it had been higher earlier, and they actually put up a decent quarter where their loss beat estimates, the revenues beat estimates, and we'll be digging into what's dragging on that stock at this point. And then Dick's Sporting Goods, we actually have an upgrade in terms of a price target being raised, but it's interesting, Manus, we did, of course, have breaking news moments ago that Wilson tennis racket maker Immerse Sports has filed for an IPO. Maybe that will help out Dick's in the future.
Yeah, everybody's looking for the next IPO. Abby, thank you very much. Abigail Doolittle on what's under the hood. We'll see how these cash markets open in just a few moments. Coming up on the show, let's get in tensions in the Middle East.
We don't want to see it widen beyond Israel and Hamas. And again, we're going to keep working with partners in the region to prevent that from happening.
Oil edging higher for a second day on these Middle East tensions and turmoil. Libyan supply disruptions. That conversation next on Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
The force posture changes that the president has ordered in the region has been designed to prevent an escalation or widening or deepening of this conflict. As we've said before, we don't want to see it widen beyond Israel and Hamas. And again, we're going to keep working with partners in the region to prevent that from happening.
Middle East tensions are escalating. 2 members of the Iran-backed militia are dead. This after an explosion at a Baghdad security site. This comes after blasts targeted a crowd marking the death of a top Iranian general killed in 2020. And the US and its allies continue to issue warnings against Houthi rebels, as the Houthi militants, I should say, as the group claim another Red Sea vessel assault. Oil ticks higher this morning. The fears are mounting of a wider conflict could impact supply. Team coverage. Kaylee Lenz in Washington, D.C., Julian Lee in London. Kaylee, let me bring it to you first of all. There's a slow and steady rise in geopolitical tension from attacks inside Iran to more military action in Iraq. Just take us through the choreography of the first 3 days of the new year.
Well, it's been something each and every day, Manus. Today, of course, these drone attacks in Iraq that have killed at least 2 commanders of an Iranian-backed militia. Iraq is blaming U.S.-led forces for that attack, and it follows just yesterday those blasts in Iran, which Iran called a terror attack, though did not directly assign blame to any one group, and no group immediately has taken credit for it. We have heard from the U.S. that there is no indication that Israel was involved in any way, and Middle East experts I've spoken with over the last 24 hours say all signs point to this being a separate terrorist organization trying to take advantage of what is a very unstable time in the Middle East, because that really is what is so concerning about this. The idea that this is going to escalate into a broader regional conflict, because the attack in Iraq today, the blast in Iran yesterday, follow earlier this week, Israel striking a Hamas target, a very high-level member of the Hamas organization on Lebanese soil in Beirut. Just a day before that, Iran sent a warship to the Red Sea, where we know it puts it much closer to actual U.S. naval forces in the region, that together with this other maritime task force that has been assembled, they are trying to deter and defend against Houthi attacks. Now, it's clear that the Red Sea is still disrupted in terms of actual flow of trade, so there is an ongoing conversation about potentially going on offense, directly striking the Houthis, which of course are another Iranian proxy, where they are in Yemen. But again, this feeds into concern about potential escalation, because at the end of the day, the U.S. really is trying their best to avoid this conflict widening between Israel and Hamas.
And that task force, Kayleigh, Julian Lee, let's bring you into the conversation. That task force is gathering in terms of not just physical presence, but warnings. The U.S. and their partners are warning the Houthis against further attacks. They call the situation unacceptable, profoundly destabilizing, and they will hold malign actors accountable. In terms of risk ratcheting, holding malign actors accountable, that smells and sounds like something that we could trip ourselves over into something much more significant on a geopolitical front.
Yes, I think it does. I mean, I think they've been very careful to try to limit this very specifically to what's going on in the southern Red Sea, and I think these warnings are directed very precisely at the Houthis in Yemen, and I think it suggests that action may go beyond just trying to shoot down drones and missiles that are targeting traffic in the area. I don't see this as a sort of a threat to Iran directly. I don't think Iran wants a fight with the US, and I don't think the US wants a fight with Iran. But I think it is a definite warning to those who are seeking to impede the flow of ships through the southern Red Sea.
Yeah, the risk is accidents, not deliberate moves by the coalition. Kayleigh, thank you very much. Julian Lee, our Bloomberg opinion columnist. We'll hear more from Kayleigh a little bit later on. Amanda Lynham is my guest, along with George Gongalves. Okay, Amanda, I want to bring it to you. I mean, both of you will say to me, oh, we don't trade geopolitics. We just sit back, we watch, we observe. I mean, that is an impossible position for risk. Are you having more deeply concerned conversations about geopolitics and how it might impact risk and oil prices? Last year was $100 oil, but how are you thinking about risks right now geopolitically?
Absolutely. I think we've had these ebbs and flows of geopolitical risks over the past several years, whether it was U.S.-China trade tensions, the Russia-Ukraine war, now the conflict in the Middle East, and the various nuances to that. I think it really has two main implications for asset allocation. One is just the potential to negatively influence risk sentiment, which we always have to be watching on guard for that. I think the second point is really feeding into this point of dispersion that has been with us for most of 2023, actually, and it really points to companies that have built resilience into their supply chains, their cost input programs, the ability to source raw materials. Are they a commodity producer or a commodity purchaser? Are they dependent upon significant freight logistics costs to get their products where they need to go? All of those will factor in and become more relevant. There are periods of time where those ideas and those nuances matter less, and there are times like today where they matter much more, and so that will be relevant. Now, there are certain sectors that are more exposed to that, which we are paying a lot of attention to. I think one of the sectors that's positively positioned in that is actually financials, not dependent on making a widget and shipping it across international waters, things like that. And so I think that on net, it actually supports the case for financials from a sector allocation perspective. The last point I would make, Manus, is that it just further emboldens the case for onshoring, nearshoring, friendshoring, which is a longer-term structural trend that we're also watching.
Yep, and that's only going to play out, I would imagine, in the political conversations between now and when we get to the election. George, let me bring it to you. What is defensive for you? I'm drawn to your call on short-term IG, short-term bills. That's slightly more a rates call, but in terms of a slightly more defensive positioning to geopolitics, or do you just go, Manus, I don't trade politics?
No, look, in macro, we're obviously highly influenced by the geopolitical backdrop. So if this were to escalate further, it does throw a monkey wrench into what is the right move out of the Fed. On the one hand, cutting rates and providing financial easing would probably add to the inflation fire if oil were to move higher there, but also would be supportive of the banks. So I generally agree with that view that Amanda has as well, that banks should do well this year. The Fed wants to ultimately steepen the curve. So the idea is whatever gets them to steepen the curve faster, that's going to be good for leverage plays and for interest rate sensitive sectors. But in general, though, if this were to get worse, what we really have to watch is inflation break-evens. Inflation break-evens last year barely moved. I mean, we've had all this concern about inflation. The Fed was hiking rates, finished the hiking cycle. Yep. And inflation really wasn't concerned. We had very low volatile inflation expectations. If that were to pick up, that would also get the Fed nervous.
We'll keep an eye on those break-evens, on the 5-year break-evens. Thank you, team. George Gongalves and Amanda Lynham on the markets. Coming up, your morning calls. Abercor's Julian Lee, Emmanuel Mac, expecting stocks to go nowhere in 2024. That conversation still ahead, right here on Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
Get your morning calls in and a look at what the analysts are saying. First up, Barclays upgrading Home Depot to overweight, expecting stronger demand and higher home prices. Next up, JP Morgan upgrading American Express to overweight, recommending a more defensive stance within the consumer finance sector. And finally, Apple having a brutal time of it, receiving its second downgrade in as many days. Piper cutting the shares to neutral on growing iPhone inventory concerns. Coming up, I get the name right this time. Evercore's Julian Emmanuel joins me. A lost year for equities. I hope not. The conversation on Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rating World Cup. This is a 3.
As the economic picture does. Is it the okay is getting ready to make a decision?
Down to the open. Are you nervous? Bond yields are rising. These equity markets are nervous that we're going to have a reverse Goldilocks scenario. There is the opening bell. We're going to roll it over and have a look at the cash prices. Of course, semiconductors were under pressure yesterday. Apple has had its double downgrade. That is dragging the NASDAQ lower, and this is the state of play on the futures. There is the opening bell. As I say, keep an eye on Apple and some of the big chip makers, which, of course, were the bellwethers of 2023. We're rolling down here. This is a reverse Goldilocks scenario. The Russell ticks up ever so slightly. Across the rest of the assets, this is what we've got for you. The euro-dollar at 109.43, ticking higher ever so slightly. There's a big old note out from Morgan Stanley this morning. They're dropping their contrarian bet on the dollar to rally in 2024. The dollar's down for the 4th day in a row, and the euro is bid a little bit higher. 10-year yields. It really wants to kiss 4%, and if it does that, what does that do to that tech bet? Crude is up by 0.25% as we see geopolitics really rising around the Middle East in terms of supply outages in Libya, along with more angst in the Red Sea. There's only one stock to watch. It is, of course, Apple. Well, of course, there are a few others. But we're down for the 4th day in a row. Another analyst downgrade. This time, it is from Piper Sandler. Ed Ludlow is with us from San Francisco. Now, this comes down to inventory. But, of course, we've had the evangelist, Dan Ives, on to rebut this. Ed, good morning. First of all, what are the details on the downgrade?
Yeah, I think Piper Sandler, in sort of solidarity with Barclays, that was the leader on downgrading earlier this week, look at the data on how the iPhone 15 is doing, both in terms of volume and mix, and they have big concerns about the growth trajectory, right? The run of 4 quarters of decelerating sales growth over 2023, calendar 23, was a big concern to the market, and Piper Sandler, in downgrading to neutral, are basically saying we think that trend will continue into calendar 24. This is a firm that's held a pretty bullish view on Apple going back to the early days of the pandemic in March of 2020. In the 4-day period, we're down a percentage point for that 4th straight day of declines on Apple. It's more than $170 billion of market cap shed. And we go back to what we discussed 24 hours ago. Yes, a 50% gain in 2023 for Apple, but of the Magnificent Seven, it was the sort of most lackluster of the big tech. It also has the sort of least bullish consensus, if you go on ANR on your Bloomberg terminal, of all the big tech stocks, the fewest buy ratings. Another really important stock that we're watching this morning, Manus, as well, is Mobileye. It's on track for its biggest decline on record. Why? It gave us a prelim look of its full year 24 sales outlook, revenue of 1.83 billion to 1.96 billion for this year. But the street was looking for 2.58 billion. The story here really simple. Mobileye makes chips or systems on a chip that power the sensor suites for advanced driver assistance in cars. And what they're saying is that after the chip crunch of 2020, all of those tier one suppliers that were worried about chip shortages for ADAS bought up inventory. Those inventories are too big, and so now they've stopped buying, and they need to work through the inventories, which Mobileye says will happen in the first quarter of this year. The other thing that's happened is that the automakers have cut their production targets for this year as well, which has a downstream effect on the number of cars that need advanced driver assistance solutions. That stock down 27%, but look at many other chip makers that supply the automotive sector. They're also lower on this idea that either there is a glut in automotive chips that needs to be worked through, or at the downstream side, production of these automakers is definitely going to hit some of those key suppliers.
It's amazing how we vault from, you know, famine to feast, Ed, and then of course there is all about the acceleration in terms of the electric vehicle production, and that looks shaken in the traditionals, but powering ahead of the likes of Tesla. Kathy Wood buying Tesla again today. Okay, Ed, good to see you. Let's get into some of the earnings. We've got the food sector. We've got Cal-Maine shares under pressure after a drastic decline in egg prices weighed on a quarterly basis. Abigail Doolittle is with me. I'm a big buyer of eggs. Good morning, Abby.
Well, apparently your big buying didn't help them out, and not because you weren't buying the volume they needed, but because, to your point, prices on eggs are down, an example of real-world inflation declining. Relative to the stock, it's interesting because in the pre-market it had been down as much as 5%, more than 5%, heading to a fourth down day in a row, but now it's up slightly, probably because of the decline into today, right around 7%. So some of this may be priced in. Relative to that adjusted earnings miss, they missed by 57%. They put up 35 cents, and that's also a 91% year-over-year decline, so some real weakness there. But it seems as though with the stock up a bit, now up quite a bit, up 1.75%, that investors are relieved that it wasn't worse than perhaps what they had expecting. They also mentioned that they lost about 3% of their flock. As for Conagra, the packaged food company, that stock is down 1.2%. They put up a mixed quarter. They beat adjusted earnings by 4%. They missed sales by 1%. But the big deal, Manus, is the fact that they cut their outlook. They now expect organic growth of 1 to 2%. And this is interesting because they're saying that consumers are cutting back on packaged food buying, and it's not limited to cash-strapped consumers. It's also high earners. So it looks like there's some frugality there as at the end of last year, perhaps into this year. And as a result, they now expect volumes to be down. That stock over the last year, down about 24%.
Abby, do you know what you've managed to make me find on the Bloomberg terminal?
What?
The price of Class A. A dozen eggs, Class A dozen eggs, down by 50% in terms of price. That's what you provoked me to now. There we go. Price of eggs. You can get everything on your Bloomberg terminal. Let's stick with the earnings. We've got Walgreens slashing its dividend nearly in half, despite topping its quarterly profit estimates. Why? Simone Foxman, tell me more.
Yeah, and talk about wild swings here in Walgreens. We've seen shares up as much as 4.7% in pre-market, now trading down over 9.5% in the first few minutes of trading. That dividend that you mentioned, that was actually seen as something that's positive by analysts, including Raymond James. Cowen saying that it removes the overhang and provides the company with more strategic options. So that was on the good side. Also on the good side was earnings per share that came in ahead of expectations, as well as sales, and the company able to in fact maintain its full year fiscal outlook, something not every analyst believed it could do. However, we started seeing pre-market shares really start falling pretty substantially as the earnings call went on, and part of the reason may have been that the company looking at retail comparable sales for the fiscal year, expecting now that they will decline in the low single digits. Previously expected they would be flat. Also talking about a more challenging environment versus the previous outlook. Analysts are very much hoping that the company will shift more into healthcare-related stuff. But the CEO also said he doesn't see more primary care investments. One wild card here could be the potential sale in the future of the Boots chain, the international part of its business, for as much as $8.8 billion. but at least at the moment, analysts really not liking what they see, and this after a 30% decline in Walgreens shares last year, Manus.
That is a brutal price drop, down 9.4%. Simone, thank you very much. Finally, let's turn to the home builders. Where are we going to go in 2024? We have a New Year hangover. UBS downgrading the shares of Pult Group to neutral. Katie Greifeld is alongside me, so this is a bit of a punch to one of the home builders. Good morning, Katie.
A little bit, but Manus, this is really a case of being a victim of your own success. You take a look at Pulte Group. Remember, it rallied almost 127% last year alone. You compare that to the broad home builders index up just a pedestrian 81%, and that's a big reason behind UBS's downgrade to neutral. The firm is still positive on home builders in general, but when it comes to Pulte Group, margins and returns should normalize more than its peers, a process that will take us through 2026. And that normalization process, it's expected to limit Pulte Group's upside to its current valuation. It's important to note, though, here that while downgrading Pulte Group, UBS actually lifted its price target to $120 from $93. And for context, you take a look at shares right now, currently trading around $100 or so, and it's actually up a little bit higher, so defying this downgrade overall, Manus.
Okay, Katie, thank you very much. Katie Greifeld there on the builders and the outlook. And of course, Julian Emmanuel, looking ahead for 2024, says this: anticipating a recession and volatility is like watching paint dry. Forward indicators suggest recession is near. Yeah, recession canaries, along with the credit spreads and the VIX, say not quite yet. Julian, good to see you. Very good morning to you. So it's a recession delayed, not denied. Given the ADP numbers, we're running into the jobs report tomorrow. And we've got Lausch, FCON. So how firm a footing are we in the first half? How short-term or medium-term are you looking at?
So we expect a recession at mid-year. And again, part of what has been, frankly, a happy circumstance and a bit of a mystery is that the labor market has stayed as resolutely strong as it has. And the data, again, confirm that today. But when we think about the equity markets in general, the issue facing stocks in the first half of the year is that the optimism accumulated over these last few months, and obviously the consequent rally that accompanied that optimism, really make the market much more prone to reacting to news that's anything less than perfect. And of course, again, part of the narrative of this week is that stocks have sold off in response to the fact that yields seem to have found a floor given this economic news.
Do you think we're entering into a form of anti-Goldilocks, reverse Goldilocks? Because if you think of the last 2 months of 24, it was a syncopation, wasn't it, between bonds and equities. Here we are, we're trying to get to 4% again. We're trying to sort of recalibrate our bond rate to 4%. And in that recalibration, it's provoking in some way a response mechanism from the equity market. So do you believe in reverse Goldilocks?
I don't think it's necessarily a reverse Goldilocks, more over the fact that again, given the rally since the lows in October, and given the surge in sentiment, surge in call volumes, and this general expectation of Goldilocks, what you are is more susceptible to gyrations in yields more than anything else. And at the end of the day, you really traded in and around 4% on the 10-year yield for the last number of weeks, and that's filtering into noise in the stock market.
If we're to reappraise the pricing in the bond market is for 6 rate cuts. That's been tempered, I think, from the FOMC minutes. To a certain extent, we all got over our skis in understanding what Powell meant on December 12th and 13th in regards to the pivot. So here we are, we're trying to recalibrate. You say it's going to start wild and promises to get wilder. My question is, are we going to get a wilder reappraisal in the equity market than we are in the bond market? I mean, who's the tail on the dog here? Is it equities or the bonds?
So if you look at the last 2 years, the tail has been the bond market wagging the dog of the equity markets and to a lesser extent the credit markets. All the volatility has been in the bond market. It's our expectation that after sort of a historic relationship where bond volatility has been extreme, and equity and credit market volatility have been much more muted, that you're going to have a convergence of that. And again, when you think about it with this, particularly this backdrop of an earnings season that's going to start next week, where expectations for full year 2024 are high, even in a no lending scenario, it's reasonable to expect more equity market volatility.
Sort of part of me secretly delighted that you say we're going to retest the 200-day moving average, because I'm in that no man's land of transferring my life from one country to another, and I'm uninvested in my pension. You said we're going to test 39.70 before we move higher again. What is it that gets me back to 39.70? Cash trades at 4,700 at the moment, so that's not an insignificant retracement.
So there's two ways of thinking about this. First off, 2023 was a very rare year in that volatility, as we all know, was extremely subdued. The market, with the brief exception of the July to October downdraft, essentially traded straight up, and of course for a few weeks in March. The typical year without a recession sees a pullback of 13%. That alone, if you didn't have any economic softening, would get you to the neighborhood of 41.70. It's our view that at some point towards mid-year, the market will have to do a little bit more discounting, not only the potential for the softening in the economy, but also the potential that, given geopolitics, that inflation is perhaps not as quick to fall as the expectation for rate cuts priced in as well. And the confluence of all of that, plus this extreme confidence as we enter 2024, likely causes the sentiment shift that gets you towards those figures.
Okay, well, there's a few more banana skins out there for us in the markets, and we'll talk about those in just a moment. Evercore ISI's Julian Emmanuel sticks with us. Coming up, markets brace for, you got it, presidential election.
We could see Trump as the presumptive nominee by Super Tuesday, which is March 5th. It's entirely possible this will be over in 2 months.
That conversation next on Bloomberg.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
Do you see a future for Monumental as a public company?
Yeah, I think so. I think what we found is the leagues have opened up to new pools of capital. Over the last year or two, both the NBA and NHL have allowed professional investors to come in, not as individual owners, but as funds. So that's a whole new pool of capital that didn't exist before. Sort of shows a whole new asset class opening up for professional sports, not just teams, but professional sports enterprises.
I think the sophisticated analysts will be looking at this industry, and as our revenues start to get in the billions of dollars, yeah, I think that you'll see a wave of companies go public. Whether we will or not, there's a big responsibility when you're a public company. And I tell people, we're a public company already. The scrutiny that you're under in running a sports team is, I think, much higher than a public company CEO has to live with. We'd be prepared to do it. Just the market would have to be right. We'd have to emotionally be ready to do something like that. But I think Monumental will be one of the 3, 4, 5 best-in-class organizations that, if that time was there, sure, we could go public.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
They're just fighting for second place, John. I don't see, there's maybe a chance in New Hampshire that Trump could slip below 50%. Trump will do very well in Iowa. We could see Trump as the presumptive nominee by Super Tuesday, which is March 5th. It's entirely possible this will be over in 2 months.
Will it really be over in 2 months? Presidential hopefuls gearing up for pre-caucus spotlight. GOP contenders Nikki Haley, Ron DeSantis set to grapple in a series of back-to-back Iowa town halls. Meanwhile, the Republican frontrunner Donald Trump urging the Supreme Court to keep his name on the Colorado ballot. And President Biden prepares for twin events designed to take his aim at the opponents across the aisle amid a worsening polling set of numbers for him. Kaylee Lyons is in D.C. soon to pack her bag and go on the road for weeks at a time. Kaylee, good to see you this morning. Where should we start in terms of Iowa? How important is it for these two contenders to have a good showing in these kind of debates? Will it help define where they are?
Well, Iowa really is going to be, Manis, for Nikki Haley and Ron DeSantis, a question of whether they can put up a strong enough showing in second place, because Donald Trump, it is highly likely, is going to win Iowa. He is leading in the polls there by a wide margin, just as he is leading in most national polls by some 50 points. If they can put a strong enough showing in Iowa, either Nikki Haley or Ron DeSantis, the theory is that maybe they could ride that momentum into New Hampshire. Nikki Haley is only behind Trump by 14 points in the Granite State in the latest St. Anselm poll. So it does make these town halls incredibly important. All three of them will be appearing in Fox News town halls next week. And then on Wednesday, the 10th, it will be Nikki Haley and Ron DeSantis only on CNN. This, of course, comes against a backdrop of Trump's myriad legal challenges, including the question of whether or not he can even be on the ballot in states like Colorado and Maine. Trump and his legal team, of course, asked the Supreme Court yesterday to take up the Collar ruling that barred him from the ballot on the grounds of the 14th Amendment, which essentially says no one can hold public office that engaged in insurrection. Trump saying he did not engage in insurrection, and also that the 14th Amendment doesn't actually apply to the presidency. So that will be the legal question before this highly conservative U.S. Supreme Court, 3 justices of which were appointed by the former president. And just finally, this also speaks to how Biden is trying to cast this 2024 race, essentially the idea that Trump is a threat to American democracy. That is the message he will be taking to Valley Forge, Pennsylvania tomorrow. Of course, in a swing state, also a historically important location in terms of the American Revolution, to talk about this Democratic threat. He also is going to head later on Monday to South Carolina at the historic Black Church in Charleston, where 9 churchgoers were killed by a white supremacist in a mass shooting back in 2015. South Carolina, man, is, of course, significant, not just because it's the home state of Nikki Haley, where she served as governor, but also because Biden is really struggling to retain the black vote at this point.
Yeah, a lot of struggles for Biden. I mean, what is it in the swing states? We've got our last poll that we did, 58% of the voters in those swing states hold an unfavorable view of Biden, but 53% hold an unfavorable view on Trump. So these first sort of couple of weeks are going to define perhaps the zeitgeist as we go forward. Kaylee, it's my first time in America for a full election cycle. I'm excited for that. Kaylee Lyons there in D.C. And of course, Julian Emmanuel is our guest this morning, weighing in on markets during election politics. And this is what he says. The narrative has shifted from presidential election years, which are generally good for stocks, to, January, February of election years tend to be weak. 2024 has started wild, and it promises to get wilder. So, Julian, good morning. On the political front, you say that we need to understand they who control Congress will control, obviously, a great deal of the political narrative. What are we underestimating right now, the start of what's going to be, I think, a pretty exciting election year?
Well, what we're underestimating is, first off, this is a year where macro, as has been the case very much the last couple of years, is likely to drive the narrative. And when you think about it in the context of politics, what we did was we looked at election years, where the balance of power in the Congress is as finely balanced as it is now. 10 or fewer seats in the House, 2 or fewer seats in the Senate. And what we found is that those election years were inherently much more volatile than typical years, frankly, some with a downside bias. But in general, what it speaks to is the restlessness of the electorate and this whole idea that the campaign, as we know, even though we're pricing it, is likely to remain contentious, but against the backdrop of geopolitics as well, promises to underpin volatility in a way which didn't happen in 2023.
Okay, well, we're gonna. I'm transfixed, quite literally. An Irish man transplanted to the UK, living in the Middle East, with not an election under my belt since Brexit. So I am fascinated to see how things change and how the ballot gets decided. I think it's going to be a pretty punchy one. Julian, thank you very much. Good to meet Julian Emmanuel there with the very latest on politics. Coming up in the show, markets move. Events define the future in the trading diary. We'll give you what's on the slate right here on Bloomberg.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg.
Time for your trading diary. This is what you need to keep an eye on for the rest of the week. Obviously, payrolls tomorrow is the all-important one. Plus, the Richmond Fed President Tom Barkin speaks. Next week, it's all about inflation and the CPI, supercore CPI to be exact. Jobless claims on Thursday, and finally the PPI on Friday. It's day 2 sitting in for Jonathan. Don't worry, he will be back. Let me leave you a snapshot of Apple. 4 days, 6% lower, and $180 billion lighter on market cap.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Vince Piazza. He's the senior analyst of Bloomberg Intelligence. He covers the energy biz. We've got an M&A trade in the shale patch here. We're going to break that down with Vince. And then we're going to tech. We're going Mandeep Singh, senior tech analyst of Bloomberg Intelligence. He's going to talk to us about TikTok's e-commerce ambitions. They're going after Amazon.com. How about that? Then Philip Palumbo, CEO and founder of Palumbo Wealth Management. We'll get his market call for 2022. But first, let's kick things off here with Nathan Hager in the Bloomberg Business Flash.
Well, Paul, tech stocks are selling off just a bit, and Treasury yields are back on the rise, and it's all about the data. Strong private payrolls numbers from ADP and lower than expected weekly jobless claims are making investors sort of dial back their expectations for when the Fed might cut interest rates and by how much. Amanda Lyman is head of macro credit research at BlackRock.
Really, what the data this morning is highlighting is that there are upside risks still to the economy. And so the market is probably right in calibrating expectations for significant swift rate cuts in the early part of 2024. And I think that that's appropriate.
All right, let's check those markets as we do all day long here on Bloomberg. Right now, the S&P 500 is up 0.2%, up 7 points. 4712 is the S&P level. Dow Jones Industrial Average is up about 0.5%, up 173 points at 37,604. The NASDAQ Composite lower by 0.3%, down 41 points, trading at 14,550. 10-year Treasury down 30 seconds, yield 3.98%, close to 3.99. NYMEX crude is up about 0.25% at 72.88 per barrel. COMEX gold is up 0.3% at $2,048.70 per ounce. The euro 1.0955 against the dollar. The yen is at 144.69. Bitcoin's up 2%, trading around 43,800. That's a Bloomberg Business Flash, Paul.
All right, Nathan Hager, thank you so much. We appreciate that. Paul Sweeney, flying solo again here for the next 3 hours. How about that? We're live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio, and that's where you will find us. So we're audio, we are video, we're doing it all here. Again, red and green on the screen, as Nathan was just reporting here, but there are definitely some stocks moving under the surface there. Let's check in with Emily Grafeo. She covers all the markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at?
I'm keeping you company
Thank
here,
you.
at least for these next few minutes. So I'm looking at Walgreens. That stock is down about 12% right now. The new CEO, Tim Wentworth, said that they're going to be almost halving their quarterly dividend to 25 cents a share. And this is part of a broader cost-cutting effort that the new CEO has implemented since he joined in October. They've been closing unprofitable locations, putting the brakes on non-essential projects, and then executives also have said that they aim to reduce CapEx by about $600 million. The stock was down 30% last year, down again about 11% today, the most intraday drop since June. Not looking great for Walgreens, but I guess they are trying to turn it around with
That
these
is a tough business. Tom Keene brought that up last hour. He was just kind of looking at the FA function on Bloomberg, which lets you see all the financial statements. And this is a company, like a lot of retailers, operates on razor-thin margins. Their net income margins like 1 to 2%. You know, see if you have any misstep at all, it just impacts you here. So, plus I have the problem. If you go to the Walgreens here on Lexington Avenue, you can't even get a toothpaste because it's all in lockdown behind these locks for these cheap little products. But apparently that theft issue for some retailers in some parts of the world is a real issue. So I'm guessing that's true for some of these grocery chains, drugstore chains, that kind of thing.
Yeah, it doesn't work well. Like, as a New Yorker, when you're trying to go into a drugstore quickly, go in, grab something, and leave.
Yep, no more.
Everything's locked up. I'm like very impatient.
But don't they have to hire people to stand there to unlock it for you?
Yeah,
so
right.
I don't know.
And they have a labor shortage. There's only like 2 people working.
Yep.
Anyway, I'm also looking at some cryptocurrency-linked stocks. We have Coinbase up about 2%, Marathon Digital Holdings, which is a miner, and then also Invesco up about 2% today. They're one of the issuers that's waiting to hear SEC approval as to whether they'll get
I guess,
that Bitcoin
as I
ETF.
understand it, the SEC has until, I guess, the 10th, January 10th, which is next Tuesday, to issue a ruling. And presumably it's going to be with Cathie Wood's ARC ETF product. Then presumably others will follow. So it's any day now up until Tuesday we could hear, right?
Yes. So January 10th is the deadline for the ARC 21 shares spot Bitcoin ETF filing.
Okay.
So we'll hear something on that date or before then.
Right.
That's the only fund that has that January 10th deadline, but there's been a lot of speculation that if they approve one or reject one, it will likely apply to all of the funds. So there's been a lot of volatility even in Bitcoin's price. It was down about 5% yesterday. Now it's back up to 43,000. So
and had that big run up towards the end of last year to over 45,000. So
people say the hype is linked to this spot Bitcoin ETF approval. If this actually is approved and there's anticipation for it and excitement, then it'll propel the Bitcoin price higher. I'm a little skeptical. If we know it's coming, wouldn't all of that excitement already be priced in, especially after the run-up? So we'll have to see what happens. But that's coming up really any day now, that spot Bitcoin ETF decision from the SEC.
All right, very good. That is some good stuff. Emily Grafeo joining us here in our Bloomberg Interactive Broker Studio, giving us some color here on what's happening out there in those equity markets. All right, it's Thursday, so it's not, Merger Monday, but there's a trade out there in the shale business. And we've seen a lot of consolidation in the shale patch out there in really the last couple of years. And we have another deal here, APA to buy shale oil driller Callon Petroleum for $4.5 billion. And we want to talk shale. We talk with Vince Piazza. He is our energy analyst for Bloomberg Intelligence. Hey, Vince, I know you've been busy recently kind of parsing through all these M&A trades in the shale patch here in the U.S. Talk to us about what APA is. What is APA doing here with this acquisition of Callon Petroleum?
Yeah, well, look, in the Permian, Paul, and by the way, Paul, Happy New Year to you and yours.
You too, sir.
What we have here is a jump ball for acreage in the Permian, and we've seen this across several years. It paused and then kicked up again most recently, but this is really about larger players looking to gain scale and smaller players looking at the environment in front of them with higher rates and big guys getting bigger. There's really not a lot of room for them. And, we follow roughly 14, 15 names in the Permian that are below 500,000 net acres. And they need to do something. They need to do something to survive or to put themselves up for sale. And Callon did. And we see this as a continuation of consolidation for scale and asset concentration. These guys are selling a commodity. There's very little differentiation. The way you gain efficiency, the way you gain productivity is to be big, to have scale, to have concentration across your region. And in this case, it's the Permian. We've seen a lot of M&A in the Permian on the oil side. We haven't seen a lot on the gas side. I think that's where the real story will be in 2024. Natural gas has likely bottomed in 2022. We should see better conditions, better balances. We should see more consolidation in the gas side as well, especially with the curve the way it looks. And we'll probably see that more in the Haynesville and also in the Marcellus. But what this really tells us is there is scarcity value, right? And so you are bidding up smaller operators, mid-cap operators, operators that were privately sponsored, and the PE shops need to monetize these investments to recycle that capital as well. So you're seeing small, mid-sized PE-backed names selling out, and you're seeing publicly traded names also selling out, especially in an environment where you have higher rates. In the case of Callon, they were one of the higher levered names of the companies that we follow. So, I think it is reality coming to call on them and other smaller operators.
Yeah, I mean, I'm just, Bloomberg's got some good reporting here, just summarizing what's happened so far. Just recently in October, ExxonMobil reached a $60 billion deal to buy Pioneer Natural Resources. Chevron followed it up with a $53 billion agreement for Hess Corporation. And in December, Occidental Petroleum agreed to acquire Crown Rock for $10.8 billion. So, Vince, as you say, a lot of deals getting done here. Talk to us about just the natural gas market in general. Because when we talk about energy, we tend to talk about oil more than nat gas here. Talk to us about where we are in that market today. What's the outlook?
Well, the outlook right now, just given the backdrop for weather and the rather mild temperatures that we've had here early on in the winter season, it's been a tough go for natural gas. We would have thought we would have seen a better bid into the winter, but with a very mild December and a little bit turning here in January as the cooler temps settle in, but it's been a pretty tough go. But then again, it's better than where we were last year, where we saw nat gas go below $2 very briefly. But we think we're past that point. We think 2024 balances will likely tighten. Right now we're in this mix of this 260, 250 spot. But we think that things will improve. There is a structural secular trend, and that is toward LNG exports. The U.S. has grown its export capacity. It will continue to grow this export capacity through 2020, through 2030. And we think this is a net positive to pull the excess capacity that we have in the U.S. into the European corridor and in the Asia corridor. Last year we had a lot of flows go into the European corridor, just given the fact of Russia and the Ukraine war and what that meant for energy security. So the U.S. was a buffer for that. We will continue to be a buffer for that. LNG export capacity capacity gains will be a structural story that we'll hear more of and that will tighten balances for us in the U.S. You also have gas in the power stack that has gained share and that will continue to be stable over the next year or so. We will continue to gain share there as well on the industrial side. So you have both a cyclical story, which is the weather component that we can control, but there is also a structural component to it that does provide longer term growth for natural gas, not just as a transition fuel, not just as a bridge fuel, but as a key component within the energy complex, the energy portfolio.
Hey, Vince, you know, it's interesting that the U.S. has become a net exporter of oil here, and a lot of our listeners probably aren't aware of that, particularly the ones that kind of remember back in the 70s when we had those oil emergencies and shocks here, and a lot of that's due to the shale. You're the expert on shale, you're the expert on fracking. Can you explain to us when these frackers blast in a bunch of this water into the rock, what comes out in terms of oil versus natural gas? How does that typically work?
Yeah, so in a place like the Permian, where most of the M&A activity is occurring, not only do you have your crude oil, but you also have what's called associated natural gas or associated gas. You know, typically you will have something to the effect of 2/3 liquids, 1/3 gas. That gas has to go someplace. And it has been a big boon to a place like the Permian, which is the third largest producer of natural gas as a standalone basin, which is really incredible when you think about we're really drilling for crude oil in that basin. But what we have here is a plethora of natural gas, and the export market is the most likely area for it to move through in order to balance these markets. In general, no matter where you drill, you're going to drill some natural gas if you're drilling for crude oil as well. So when we do talk about natural gas, it is a default to talk about crude oil as well, since that is the driver of what we come up with when we also drill for natural gas and oil. So it is the thing that stirs the drink for the natural gas market as well.
So, I guess we all kind of got a little bit more smarter on liquefied natural gas when Russia did invade Ukraine, and that really cut off the supply of Russian gas to Europe. And we've got a lot of it, but it's not easy to transport, is it? You got to do this whole liquefaction process. How is that whole part of the industry developing?
It's developing very rapidly. We're growing capacity. We have become a key exporter to not only Europe, but also to Asia. One thing that is quite key for us here in the U.S., and we saw this last year as well, our ability to adapt quickly and move those molecules into the market that needed it the most. We were saved by a relatively warm winter in Asia, and we were able to move those molecules into Europe to help them restock their storage. We have here in Europe relatively stout storage at well over 83% filled. And so for this winter, at least, natural gas storage is not going to be an issue. And we've done an exceptional job, and the European Union has done an exceptional job refilling its capacity to deal with any uncertainty that would occur, not only on the war front, but also in terms of weather as well. So natural gas in the U.S. being exported to other countries has been a key contributor to how we are looking to balance our market here in the U.S. And, right now, with Europe being filled, the Asia market is looking quite attractive, and it is more profitable to move those molecules into Asia relative to the European market.
Vince, great stuff. Great tour de force there on the energy space, nat gas. Vince Piazza, senior industry analyst covering the energy space. We've got a great energy team, a global energy team, because you have to look at energy on a global basis, and that's what Bloomberg Intelligence does. We appreciate getting some time from Vince Piazza here. Again, some more M&A in the natural gas space here in the U.S. in some of those shale basins. As Vince was saying, there's a lot of demand there, and there's a need for scale, particularly from some of these smaller companies. So, again, saw another deal today. APA to buy shale oil driller Callon Petroleum for $4.5 billion. So good stuff there. WTI crude, just to round out the discussion on energy, kind of flat today, $72.77. So we'll keep on top of the energy complex. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You got it, Paul. Talk about a rough week. Apple shares down for a fourth day in a row. Now, the tech giant's been hit with its second downgrade this week. We get more from Bloomberg's Ed Ludlow.
Piper Sandler, in sort of solidarity with Barclays, that was the leader on downgrading earlier this week. Look at the data on how the iPhone 15 is doing, both in terms of volume and mix, and they had big concerns about the growth trajectory. The run of 4 quarters of decelerating sales growth over 2023 was a big concern to the market, and Piper Sandler, in downgrading to neutral, basically saying we think that trend will continue into calendar 24.
Apple is down more than 1%. The AI boom is pushing Microsoft to make a big change. Bloomberg's Joan Doniger has that story.
How dialed in is Microsoft on artificial intelligence? So much so, it's adding a key to the Windows keyboard. The AI Copilot key will sit to the right of the spacebar. This is the first change to the Windows keyboard layout in about 30 years.
Microsoft up about 0.3%. Mark Zuckerberg went on a selling spree in the final 2 months of 2023. Now, according to a filing, the Meta chief executive sold shares on every trading day between November 1st and the end of the year, unloading nearly 1.28 million shares for nearly $500 million. Now, this comes alongside a 194% rise in Meta's stock price. Now, the last time Zuckerberg sold shares was back in November of 2021. Meta right now is up just about 0.1%. And TikTok planning to grow its e-commerce operations in the U.S. The internet company sees a potential for more than $17 billion in sales this year. I'm Lisa Mateo. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. We check the markets all day long here on Bloomberg. Treasury yields are rising. Tech stocks are slumping, with robust jobs data sparking doubts about how soon and how deep the Fed can start cutting interest rates. S&P 500 right now is up almost 10 points, or about 0.2%. The Dow is up 164 points. That's a gain of 0.4%. The NASDAQ Composite is down 17 points. That's a drop of about 0.1%. 10-year Treasury down 17 30 seconds, yield 3.98%. 8 of the 11 main industry groups in the S&P are in the green right now, led highest by financials and industrials. NYMEX crude is little changed now, down 6 cents to $72.63 per barrel. COMEX gold is up 0.4% at $2,050.40 per ounce. The euro, 1.0957 against the dollar. The yen is at 144.57. Some of the biggest movers individually right now, Walgreens Boots Alliance is down 10%. The earnings came in better than expected, but the drugstore chain is cutting its dividend, and the CEO says more changes are on the way. Peloton is up nearly 10%. The workout giant announced an exclusive partnership to bring some of its content to TikTok. Hashtag TikTok Fitness is what it's going to be called when Peloton content goes outside its own ecosystem for the first time on social media, Paul.
I'm a big Peloton guy.
I know you are.
Yeah.
You got your favorite workout leader, right?
Jen Sherman, of course.
There you go.
Big fan. So there's a lot of good ones there. But
Stay
we got
on
the
the
bike. We got the what's the little running the treadmill thing. So I mean, it used to be a spare
those as
bedroom.
well?
It used to be a spare bedroom. Now it's basically the Peloton room. So there you go. All right, Nathan Hager, thank you so much. We appreciate it. All right, here's something that I don't do. I don't TikTok. I know it is just a monster of a social media platform, particularly with the younger demos, and really a competitive threat to a lot of the existing social media platforms out there from certainly an advertising perspective, but maybe even an e-commerce perspective. And we've done some research in Bloomberg Intelligence on this. Mandeep Singh, he's our senior tech analyst for Bloomberg Intelligence. He mans our global tech team, which I'll tell you is one of the best tech research teams on the street, BI Go. I know I just said that about our energy team, but that's also true with our tech team as well. We have folks Europe, North America, Asia, pretty much everywhere you need to be. So Mandeep, talk to us about TikTok here. I mean, you know, my basic knowledge of these social media platforms is just get as many people as you can on your platform and then to try to monetize them by selling advertising, trying to get them to buy stuff. What's TikTok's strategy here?
Well, so they've done exactly that in terms of, you know, getting to 100 million plus daily active users, monetizing via ads, $15 billion run rate. And there is a real risk, the fact that we are going into an election year. This company could be banned. We have been talking about it forever.
Could be banned.
Could be banned.
In the U.S.?
Yes.
Because of its Chinese ownership of ByteDance?
Yeah.
Okay.
Yeah, and that's been the case, you know, in terms of a risk for the last couple of years.
Yep.
Hasn't happened, but we know this is an election year, and so there will be more focus on that. And the fact that they announced this e-commerce play, to me, it suggests they want to be out there for the small businesses. Because these are the companies that will advertise, that will create their storefront on TikTok. And once you have merchants on your platform, it gets all the more hard to ban such a platform because people are actually generating revenue.
I see
so
the strategy here. Okay.
that seems to be the play here, but we know social commerce hasn't been successful in the US. Take a look at Facebook. They tried Facebook shops, Instagram shops, never really took off. And so the play here is something that hasn't worked out in the US because the buying behavior of US consumers is very different from the Asia consumers where social commerce has been successful. Douyin, which is the TikTok equivalent, is a $200 billion GMV business in China.
So social commerce, that's a kind of a new term for me, but that's basically just taking social media users, Facebook, whatever, in this case TikTok, and having them and drive, I guess, e-commerce off of that platform, getting them to start buying stuff, and then TikTok will make
finishing the transaction within your social media app. So right now they show you an ad, and that takes the user traffic to the e-commerce website.
Okay.
In this case, the experience is in-app. It makes a ton of sense. I mean, it makes for a good buying experience if I can do things within the app as opposed to going to another app. So
why hasn't it worked here in the U.S., do you think?
Because think of how an e-commerce website works. You need logistics, you need payments, you need sourcing, you need inventory. Social media companies aren't doing that.
Okay.
And Amazon is doing that. They've built so many warehouses just for doing that. They have their own delivery. So e-commerce requires all these things. And for TikTok, they're likely going to partner. So they have already partnered with Shopify and Walmart.
Okay.
They're going to look for more partners. Obviously, Amazon has done the same with other social media companies. We would have never imagined Amazon partnering with Meta and Snapchat. They've done that. So
what's when you talk to the folks in the e-commerce world, what's the feeling about the ability of ByteDance/TikTok to actually have some success here in the U.S.?
Very unlikely, at least from my lens, given, you need to match that Amazon experience that people have in the US, right? 2-day prime shipping, 1-day prime shipping. And so for them to do it, one, they need the merchants on the platform. They need to offer a lot of stuff. But look, they appeal to the younger demographic. We know TikTok appeals to that 10 to 25-year-olds. And they can adopt a new platform much more quickly than other consumers. So I wouldn't be surprised if they use incentives to drive that e-commerce shift. But in the end, there is a political bent to it. And the reason why they're doing it is just to make sure they have a lot of small merchants on the platform, which increases their odds that they won't be banned in the US.
All right, so for those folks that aren't really that familiar with the business of TikTok, ByteDance, which owns TikTok, aims to grow the size of its U.S. e-commerce business tenfold to as much as $17.5 billion this year, according to people familiar with the matter, posing a bigger threat to Amazon.com. So that's laying it out there.
Yeah. I mean, it's an ambitious goal, but we know the U.S. e-commerce market is huge. So it's still, less than 5% of the overall e-commerce market that's out there.
And TikTok was last year on track to amass around $20 billion in global gross merchandise value, with Southeast Asia contributing the bulk of the sales through its platform, Bloomberg News reported. So now they're saying, okay, so they have some success in other parts of the world. Now the question is, can they do it here in the U.S.?
Yeah.
And when you talk to Amazon, they're a fly. We're not even worried about them. Is that the case?
I think Amazon did preempt that. So in December, they announced this partnership with Meta, with Snapchat, with Pinterest. That didn't happen so far. So Amazon and the other social media platforms want to partner with these e-commerce platforms because in the end, this is the next leg of the offline to online shift. The video shopping, the live stream shopping, which you have seen play out in China and the Asian regions where TikTok has had some success.
All right, I can't let you out of here without talking about AI, whatever that is. Generative AI market, this is your research, dude. Yeah. Generative AI market appears set to reach $1.3 trillion by 2032. What are you talking about?
Well, so what we saw last year was a bumper year in terms of what NVIDIA showed us, their data center sales. So I don't think anyone can write off such forecasts now after what we saw with NVIDIA last year. But look, it's going to happen in phases. Right now, we are still in that infrastructure phase where chip companies are seeing that demand, and more so around, the accelerator chips, the GPUs. Not every type of chip is in demand. Now you're seeing memory companies see that AI demand, and gradually you're going to see other types of infrastructure really get replaced within data centers. We are going through a massive data center refresh cycle, and then it will trickle to applications. The real disruption will be in how we use our application software, because AI is going to redefine the way we use software, and that's the 1.3 trillion component over 10 years, the disruption.
All right, here's some more numbers, because you guys have a lot of numbers in your research. Generative AI may expand to about 10 to 12% of the total IT hardware, software, services, ad spending, and gaming markets by 2032, from less than 1% based upon the BI calculations. That gives you some sense of kind of the growth here.
Yeah, and that's the disruptive element. We're not talking about companies finding new dollars to put in, generative AI. You are going to see some existing spend being migrated to generative AI for good reasons, because of productivity. Copilots make you more productive, the workers more productive, and that is why companies are going to move some of their existing spend towards these Gen AI tools.
You guys wrote a research report on this, right?
Yes.
Where can you? I can get a Bloomberg Terminal users. I mean, basically, this report tells you everything you need to know about AI.
Yeah, it's
get
a
it on the
60-page report. Yes.
60-page report.
Yeah.
BI Go gets you to Bloomberg Intelligence. That's where you can find it.
Yeah.
Anywhere else for like the non-subscriber, the non-Bloomberg people?
Oh, they could reach out to the media folks, and I'm sure they can share something.
All right, because I'm telling you, folks, a lot of people, as we all know in 2023, AI was not just a tech story. It was a U.S. global marketplace story. That drove a lot of the gains we saw in the equity markets in 2023, that and weight loss drugs. So, and I know we've got a weight loss report out there, the GLP stuff from Sam Fazeli. So, again, some great stuff coming out of Bloomberg Intelligence. Check it out on the Bloomberg Terminal, BI Go. Mandeep Singh, thank you so much for joining us. He's a senior analyst for technology, Bloomberg Intelligence. He's in the studio. He's in the office, unlike of some management level folks at BI, but I take note of that, who comes in and who doesn't. Mandeep Singh, he is our senior guy on technology, along with Anurag Rana, doing our global coverage here. Looking at the markets, S&P 500 up 0.2%, the Dow up 0.4%, a little bit of a lag here for the NASDAQ, off about 0.1%, getting a little firmer footing after the first 2 days of this year's trading. Right now, let's head down to Washington, D.C., world and national news with Amy Mars.
All right, thank you, Paul. Police say there has been a shooting at a high school in Perry, Iowa. No word yet on injuries. We're still waiting for more information from police. Today is the first day back at school for students after the holiday break. We're learning more about those 2 explosions in Iran yesterday. State-run Islamic Republic News Agency says the first explosion was detonated by a suicide bomber. Officials say the second blast was also probably a suicide bomber, but they're still investigating that. The blasts killed nearly 100 people. No group has claimed responsibility. House Republicans are turning up pressure on the Biden administration regarding the U.S. southern border. Details now from Bloomberg's Nancy Lyons.
A large delegation of Republican lawmakers traveled to Texas to see the border firsthand. House Speaker Mike Johnson says President Biden needs to take action.
Despite the White House's claim, he has all the authority he needs right now under existing federal law to stop this madness.
Enrique Morones, executive director of Gente Unida, a human rights border coalition, tells Bloomberg the GOP is misguided.
I don't think that the Republicans coming to the border to speak to the Border Patrol is the answer. How come they never speak to the migrants themselves?
In Washington, Nancy Lyons, Bloomberg Radio.
Forecasters are tracking the first winter storm of the season, expected to bring snow from D.C. to New York and heavy rain in the south, triggering flood concerns. Bloomberg meteorologist Rob Carolyn.
Weekend storm system looks to bring the first accumulating snows of 2024 to Washington, Baltimore, New York, and Boston this weekend. It'll develop in Washington during the day Saturday. It develops late in the day in New York City on Saturday, and it develops by midnight Sunday morning in the Boston area. Again, Boston, New York, Washington, and Baltimore, 1 to 3 inches because there's some potential mixing with rain. North and west of those cities, though, we expect at least 3 to 6 inches of snow to be on the ground by the time the storm is winding down on Sunday.
Bloomberg meteorologist Rob Carolyn. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager. Stocks are mixed. Treasury yields are rising. Strong jobs data has the market dialing back rate cut expectations for the Fed. Daniel Morris, global market strategist at BNP Paribas Asset Management, says the central bank is data dependent, so investors should be too.
Of course, non-farm payrolls is going to be the next growth indicator that we get. Don't want to ignore the fact that the ISM for manufacturing came in a bit weak. So what we had at the end of last year was any weak economic data was viewed positively, because that meant the Fed could cut because inflation would fall. But if that goes too far, the markets are going to start worrying about a bigger slowdown in growth, and then you worry about the expectations the markets have for earnings for equities.
Yeah, we check the markets all day long here on Bloomberg. Right now, the S&P 500 is up 10 points, or 0.2%. The Dow is up 177 points. That's a gain of about 0.5%. But the NASDAQ composite is lower, down 14 points, or 0.1%. 10-year Treasuries down 16/32. The yield close to 3.98%. The 2 years right at 4.37. NYMEX crude is down 0.6% at $72.26 per barrel. COMEX gold is up 0.5%, up $10.10 at $2,052.90 per ounce. The euro 1.0958 against the dollar. The yen 144.65. Hey, Bitcoin's up 2.8%, trading above 44,000, Paul.
I take note of that from Matt Miller.
Yeah, there you go.
Exactly. All right, Nathan Hager, thank you so much. We appreciate that. I think if you just think about the first few days of trading here, as Nathan was just reporting, we're mixed today, some green, some red. A couple of days before decidedly to the downside. So a lot of folks are saying, boy, did we pull some of that 2024 performance and risk assets and stocks and bonds back into the fourth quarter of 2023 when we had that big rally? And if so, what do we do now? So let's kind of go to that issue here with our next guest, Philip Palumbo, founder, CEO, and CIO of Palumbo Wealth Management. Philip, thanks so much for joining us here via Zoom. What's your view of kind of what we saw in the stock and bond markets there in the last 10 weeks or so of 2023 vis-a-vis where we are today?
Yeah, so I'm a buyer of any type of pullback in the markets, but in a very well-balanced way. So there's definitely been a forward move in the market, on anticipation of the Fed decreasing rates. I think more than he's going to decrease rates. But overall, there are two key catalysts that I find to be very interesting and why I'm a buyer on dips. Number one is there's going to be an earnings acceleration and growth in this year in 2024 and going into 2025, somewhere around north of 10%. And you have a Fed that's going to be decreasing rates, whether it's 3 cuts, whether it's 6 cuts, or the bottom line is going to be decreasing rates. And we're in an election year. So when you have those three particular situations occurring, you should get a good run overall with the market. The reason why I say balanced is because we can't forget, since March of 2022, all the monetary increase in interest rates that we've seen, there's a lagging effect, and we have to be careful of that as investors.
Philip, when you say balanced, what does that mean to you?
So balance means you want to